Good morning to our audience and welcome to the BCI Offshore Investment Manager webinar. This is the first day of a 3-day series extending over the next 2 Wednesdays as well. So make sure that you catch us on the next 2 sessions to follow. On screen now is the agenda for the day. Tanya and the BCI team again made for a super lineup of exceptional global managers, and we will trust that you will find great insight and value to what they have to share with us this morning. Time allowing, as usual, we will take questions in the Q&A bubble and we'll try to address those questions after each presenter as far as possible. And you know how it works by now. If we can't get to all the questions, we will circulate that to the presenters and send that back to you. So if you want us to reply on that, just make sure that you pop your name into the questions as well, and we know who to respond to. We are recording a session, and the post and the link to this presentations will be shared on the Boutique Manager's website. And as per usual, the thank you note from Olga and the team that they'll send out with the links as well. July's retail sales data paints a healthy picture for US consumer. But if you look at the job markets, it is definitely slowing down. AI boomed in anticipation of September Fed rate cuts, but time will tell if they will cut. Some say well, they will definitely, some say maybe not. But on the flip side, if you look at US stock prices, national debt and money supply, it is at an all-time high. And then we also want to know if the big beautiful bill can pump trillions into the US economy and possibly avoiding a recession. Or do we believe that the US short bond yields are still predicting a recession, maybe not in 2025, but in 2026? From an SA investor perspective, with a stronger rand, it could be the time to seek new opportunities from client portfolios. Perhaps maybe not all in the US, but you can look at areas like the UK, Europe, and even Japan, and then don't forget about emerging markets and things like China. This and so much more to be shared by our formidable global managers this morning to share their views and how they bring it together in their portfolios. It's my great pleasure to welcome our first presenters for the day, Santeri and Alexander from Bellamont Asset Management. Good morning, gentlemen. How are you?
Lovely to be here.
Yeah, Santeri, you're still on mute. I believe you're all the way from Finland, so thank you very much for joining us this morning. And from what I see, you are the fund managers looking for high-quality businesses, but say no to many that are not good. So interesting. I want to see how this comes together in the Bellamont PCI Global Equity Feeder Fund, which you are going to share with us now and your views. Thank you so much for joining again and your time this morning.
Thank you, Eugene. Can you hear me now?
Fantastic.
Yes?
Perfect.
All right, thank you.
And you got your slides, 100%.
Thank you. Excellent. Very good morning to South Africa and all the colleagues all around the world. And greetings from the Northern Europe. My team and myself, we are based in Finland. As you know, Finland is well known for the saunas and happiness. But we are here to present what we think about the quality investing. And Bellamont is, or Sifter is the management team that Bellamont has appointed for the Bellamont BCI Global Equity Feeder Fund. Since most of you are not familiar with Sifter, even though we are being active and running the fund over 2 decades now, I will shortly introduce you to the background of Sifter, also the people behind the Sifter, the key investment principles, and finally, of course, the performance and returns. My colleague Alexander will then get deeper into the investment process, strategy, and also the few investment cases we have been investing for years. And finally, of course, the current allocation. And my name is Santeri Korpinen. I'm the managing director of the Sifter. So what is Sifter and what is the background? And the story of Sifter started over 30 years ago when Dr. Hannes Kulvik started to invest his own money first in high-quality businesses. He wanted a disciplined long-term approach that avoided any speculation and only focused on companies with exceptional business models. That philosophy grew into the Sifter Fund in 2003, a usage fund based in Luxembourg. Our rule is simple: stay fully invested in listed companies, never speculate, and always apply a disciplined, rule-based method. And since inception 22 years ago, the fund has delivered roughly, okay, here we go. Sorry about that. So we've been able to return roughly 10% annual return since inception after all the fees. So what do we think about and what we believe in investing? We believe successful investing comes from the tried and tested principles and the discipline to apply them consistently. For one, every company we consider goes through months of deep research analyzed by our entire team. And every decision follows a strict rule-based framework. For second, we only invest in high-quality companies, the businesses that are leaders in their fields with predictable growth, strong balance sheets, and the ability to compound earnings over the years. Thirdly, we only invest. Thirdly, we focus only. We focus on quality over quantity, meaning that we have quite concentrated portfolio, no more than 30 companies. This way, we know that every investment truly matters to us. And finally, we maintain long-term, meaning roughly 5 years, focus with active conviction. So we hold the position as long as the investment case remains as strong as we expect, but we quickly act whenever there's any problems. So we are active when it comes to taking the decisions. These 4 principles, research, quality, focus, and discipline, they have guided us for decades and continue to drive our performance today. Maybe a few words about our culture as an investment house. As fund manager, we are more like a research house than a typical investment house. Most of us have an engineering background, and we truly like to understand the businesses and play with the companies and try to understand the technology behind the companies. So we are like a guys, engineering guys, trying to understand what makes the company very good at and what are the main reasons that the company could continue doing even better returns in the coming years. But who are the people behind the Sifter? So we are a portfolio management team of 8 professionals. We are all shareholders of this fund management company and also the investors in the fund. So our structure is simple but powerful. It's a dedicated team making decisions together, supported by an independent investment committee. This way, our investors know that every decision we make is both deeply considered and personally meaningful to us. We kind of consider the portfolio management as a team sport. Every investment decision is a team decision. We believe that diverse perspectives and open debate lead to better results. So each potential investment is researched thoroughly and challenged critically by the team members. The role of the investment committee, they are a group of seasoned professionals, founders still including in the team, and they bring additional perspective and governance. The role is to challenge our thinking, stress test our assumptions, and ensure that we never drift from the Sifter investment philosophy. However, the final decision power lies within our portfolio management team, which I'm leading. And together we can decide what belongs into the portfolio and what doesn't. And we stand by those decisions as one. So if we look at the returns last 3, 5, and 10 years, after all the fees, we have consistently ranked among the best in the class. We don't tie ourselves to an official benchmark like MSCI All Country, which is a fair reference point to all global managers, so to say. But we've been proud to deliver strong performance and even outperformance against that. However, the numbers are not just statistics, they are proof point that disciplined long-term investing in high-quality businesses truly works. So these are the performance figures, the team, and also the main principles. If we now go further, a little bit digging, how do we find those quality companies and how do we define quality business? So my colleague Alexander will take over here.
Thank you, Santeri. So indeed, we are looking for a company that has the ability to increase its shareholder value in the long term. Now, how can a company increase its value? Well, by investing into new growth opportunity at a high rate of return. So these are the three pillars that we are looking for when we are analyzing new businesses. The company must be in such a sector that has the ability for the company to indeed chase these new growth opportunities. For example, we are not investing into the alcohol industry because that's seeing a long-term secular decline, and the same could be said for tobacco industry, for example. We are only looking at companies that have a clear long-term growth potential track. Secondly, we want the company that we invest into to be the one company that takes the lion's share of this growing industry and end user market. Therefore, it's important for us to ensure that this company that we are investing has a distinct or unique business model or some other source of sustainable and persistent competitive advantage so that they indeed are able to thrive even in a business with higher competition. And lastly, we are looking at companies that are focused. They should be predictable and easily understood by anyone. So we are looking for companies with a strong management team, a clear focus on a specific product or service, and an earnings model which can be easily modeled in a financial statement. We also like companies that don't have too much debt on the balance sheet. So how do we find these companies? Well, here on this next slide, we can see our kind of company motto. We are not stock pickers. We don't go looking for new ideas in the newspaper. We call ourselves stock eliminators because we eliminate the deal flow that we get on our table on a daily basis. That includes saying no to investment cases as they come across us. So let's illustrate it a little bit further by this next slide. We are a global fund. We can invest anywhere in the world that has 65,000 listed equity opportunities. But in phase one, we kind of eliminate most of this by using our own proprietary screening methodology. That leaves roughly 500, maybe up to 1,000 companies that are kind of in the ideal ballpark for us to go looking for more. And then begins the manual phase of our process. And here we look at a company and we try to identify red flags. What's a red flag? Well, it's a criteria that we know could lead to a bad outcome in the long term, and thus we want to basically avoid investing in companies with these kind of characteristics. Maybe the CEO has not been acting in the shareholders' best interest in the past. Maybe the company has been doing really huge acquisitions at high multiples in the past. That's a red flag, and that's an immediate elimination from our point of view. Then as we go deeper into the company, we get to understand it more, how it works, how the competitors are competing against them, what are the risk factors for this company and this industry, and what are the financial models looking like. As we get more and more information, we get more and more certain that this is a good business, unless we find these red flags. So at the end of the day, we will spend up to 4 weeks, even 6 weeks, really trying to understand how the nuts and bolts work for the company we are looking at. And then at the final stage, we then finally invest or do not invest, depending on whether this new potential deal flow is better than the current portfolio that we have. So we have quite a low turnover of new companies and new names to the portfolio. It ranges between 3 to 5 per given year. We have such a high criteria for new companies that it is quite hard to find better companies out there. Now, let's make this more concrete by going through a few examples. The first example here is the biggest company that we have been invested in today, and I would say for the last 3 years. This is indeed a 10-year-old investment for us by now. So this is a company called Safran. It's a French company that make engines for the airline industry. So does this company have a long-term growth potential? Well, yes. The aerospace industry is growing, airlines are growing. There's an 8-year-long backlog for new airframes by Boeing or Airbus. So we know that there is a growing long-term end user demand. Box checked. Does this company have strong, sustainable competitive advantages? Also true. These engines take a long time to engineer, and they have very, very strict regulatory requirement for approval. You don't want to fly in an airplane with an unproven engine, right? So this means that Safran is in essentially a duopoly situation where it only competes with American company Pratt & Whitney. Very limited competition between these two companies. And lastly, is this company a predictable business? Well, yes. I mean, it's quite easy to understand what they do, and it's even easier to forecast the future cash flow for this business. Because Safran, when they sell an engine, they sell it at a slight loss, but they get long-term, sustainable, high-margin revenue by locking in the customers with sustainable service contracts. Every engine has to be maintained and overhauled on an annual basis and undergo a deeper overhaul every 5 years. We know what that looks like, so the revenue and cash flows are very predictable in the long term. Let's do another example. This is American company retailer called Costco. Costco is essentially very similar to its competitors. It sells, food, hard goods like TVs, but it doesn't really make a profit on that. They strive to keep their gross margins on products sold as low as possible to give their customers the best deal they can. So if they don't make any money on selling food or TVs, how does Costco then stay in business? Well, they have a twist. You have to be a paying member to shop at Costco. They even have a door guard that will check your membership card before they will let you in. Thus, most of the profit from Costco is deriving from this membership business. $65 a year for a typical American, multiplied by 70 million something members, and you get a very predictable, sustainable revenue pool that can be forecasted for the next 10 to 15 years. And this membership business is also a very strong lock-in effect. The typical member stays with Costco for 13 years. So the company also has a unique business model compared to its competitor. The last thing to check is this company growing? So even though this is by today quite a large business with 600 warehouses around the world, it's indeed still underpenetrated in the US, and on the international market, there's even better long-term opportunities for these companies. Let's do one last quick example. This is a Japanese company called Disco. Disco has, it doesn't do 80s dance music, but it makes highly sophisticated semiconductor equipment machines, essentially. They make saws and grinders for the semiconductor industry. These are basically sawing out things at nanometer scales, so it's very high precision. And this means that this is such a very small niche market with very high technical engineering requirement that there's essentially only 2 companies in the world that are servicing this segment. It's Disco Corporation, the market leader, and Tokyo Seimitsu. So there's very little limited competition between these 2 companies. And is this market growing? Well, yes, it is. The semiconductor industry whole is growing between 7%, 8% per year over the next 5 to 10 years. And furthermore, this company's additional upside from more complex manufacturing methods in the future, which are requiring more grinding steps. Finally, a word about the management or the corporate culture in Disco. It's quite interesting. They have developed their own capitalistic system within this corporation, where every employee gets an allocation of the company's internal currency. And this currency must then be spent. If you want to have a meeting with your colleagues, you have to spend your own currency on the meeting room, and then you have to pay your colleagues to join that meeting. And at the end of the day, at the end of the quarter, whatever currency is left over is a part of your bonus for that quarter. So essentially, they have this kind of internal corporate structure where every employee is a capitalist with the best interest of the company in mind, because they have skin in the game. I urge you to look this up. This is quite an interesting story. But that's enough example for now. So let's zoom out and look at the entire portfolio and how our investments are allocated at this point in time. You are muted.
Yeah, the current allocation tells quite an interesting story. On the left-hand side, you may see that Sifter is currently underweight in North America compared to MSCI, roughly 8 percentage points. It's not only this year, but it's been last 3 years already the same story. 50% in US and roughly 8% in Canada. In contrast, in Western Europe, we are heavily overweight, or 15 percentage points. We've been able to find truly good industrial companies from the Western Europe. In the middle box, you can see the sector, and there's information technology, industrials, and also healthcare, which are the biggest sectors and exposure at the moment. Especially in industrials, that's interesting. 20% percentage point overweight compared to MSCI. We think that this is interesting and good position and allocation for the current market environment. We try to avoid super expensive hyperscalers, but we rather rely on industrials and kind of like a little bit more less expensive companies with predictable earnings growth. I think we are running out of time. I hope not. Host, please let us know. Do we still have time?
Yeah, Santri, sorry, we are a little bit out of time, so maybe if we can pause there. I think we got a very good sense of what you do in the fund and how you manage the fund. Maybe just a quick question from my side. I mean, we know of so many big brands, high quality, high concentration, quality global equity funds. And your quick answer might be it's in the numbers, but what sets you apart? I mean, why go for the Bellamont Fund or the Sifter, which is the feeder fund, the usage fund, among all the big quality fund managers globally?
Well, a very short, quick answer would be that big is not beautiful. You can be small, and you can be effective, but you have to be disciplined. And we've been practicing doing this process and running the process and strategy now 22 years, and being disciplined to apply it in every market environment. So we don't drift the style when the market environment changes.
And I do find it very interesting. I mean, and if I compare some of your holdings, taking companies like Safran, you definitely pick up companies and investment ideas that we don't normally see in a lot of us other big quality type of funds out there. One question from the audience member, just to clarify or confirm, this is a high conviction, low turnover fund. We make sure you've got good companies, high quality companies with good return on investment capital, and you tend to hold on to them. Very last question, and I'm sure it's going to be covered by a lot of fund managers today. If you look at a company, I'll use Safran as a good example, with very good predictable cash flows. Impact on things like global tariffs on companies like that, or is it non-existent because they don't really export to the US, or how do you view it?
We did a deep review of the current portfolio to see what the negative impact could be in different kind of tariff scenarios. And the good news is that I would say 70% of our companies are not impacted at all by tariffs, because they have global supply chains. They can allocate resources to other countries to kind of mitigate most of that. Some companies, I would say between 5 to 10% of our portfolio, are indeed kind of exposed to this cross-border transfer of goods. And then the rest 15% are kind of medium impact, which is not that high in the end. It's talking about maybe this year not being a growth year. But overall, since we have quality companies, they have pricing power, they can move the cost increases to the end users, they have low levels of debt, so they can manage a long-term downturn in the end industry. That makes us comfortable with having this kind of profile in our companies, and we believe that these type of companies can indeed perform well in the long term.
Very interesting indeed, and definitely something you do keep an eye on and try to assess how it impacts on the fund as well. Definitely a good consideration if you look at global quality, the Bellamont PCI Global Equity Feeder Fund that feeds into your Sifter fund, as explained. You've got a worldwide flex fund as well, and maybe we can talk a little bit more about that fund the next time we invite you to one of these sessions. Thank you so much for your time this morning. It's really great to have you on board and to get exposure to your business. Thank you. Right, online and waiting already, a gentleman that needs very little introduction, Jared Khan from Credo Asset Management, to share their views on global equity and the opportunities and how they bring it together in the Credo Global Equity Fund. Good morning, Jared, all the way from London. Thank you so much for joining us this morning. It's really always great to have you on these sessions, and I know by now your fund are being well used by a lot of the audience. So good to get an update on your views. Thank you so much.
Thanks, Eugene, and once again, thank you for inviting me, and it's always a pleasure to come on the show. Although I've got to tell you, this is like having a presentation on the 21st of December in South Africa. Just about everyone in the UK and Europe is on holiday, but anyway, I'm not. I'm going away shortly. So I thought maybe just before we start the presentation, I'm just going to do a poll just to check that the audience is actually awake and listening, and that you just don't have the presentation streaming in the background. It also, I guess, takes a nice heartbeat in terms of the feeling of the temperature around the room and how people are feeling about the market. So the first question I've got for you is, what's your equity outlook for the next 12 months? Is it bullish, neutral, or bearish? Well, maybe we can just leave that up for a couple more seconds. And if you just click the box, we'll move on to the next question. Dan, I think when you're ready, you can maybe move on to the next question. So question number 2, again, is about style tilt. So which style do you see offering the best risk-adjusted returns right now? And I guess maybe over the next 12 months, we should say. Is it growth? Is it value? Is it quality? Or is it dividend high yield? Okay, Dan, when you're ready for the next one. So again, this is more of a macro kind of question around inflation and positioning. So if US inflation stays elevated, where would you tilt your equity positions? Would it be energy and materials, financials, technology and growth, or defensive sectors like healthcare and staples? Right, and then we have just one last question before we move on to the presentation. And this is about regional allocation and risk. How are you positioned globally? And again, how would you see yourself positioned globally over the next 12 months? Are you overweight the US, overweight Europe, overweight emerging markets, or going defensive or raising cash? Great. So I think that's all for now. Hopefully we'll get those answers relatively soon, and we'll broadcast them to the audience just to get, as I say, a bit of a heartbeat in terms of how everyone is feeling about equity markets right now. So if we just move to the next page, Dan. I've called this presentation Deja Vu, And the reason I've called it that is because I remember presenting to a similar audience in the end of February, or beginning of February, the end of January, and the markets felt very much the same then as they feel now. The market is at an all-time high. But the truth is, before we've got to that all-time high, it's actually been quite a tricky year. As you know, markets, tumbled quite heavily during the first quarter of the year, which was mainly, I would say, driven by what I would say the DeepSeek moment, and then obviously Liberation Day tariffs. And we saw a fall between the 19th of February to the 8th of April of about 20%, so a correction. And then quite amazingly, over the last 4 months, from the 8th of April to recently, the 12th of August, we've seen this massive rally in the equity markets where they're up about 30% at an all-time high. So if we just move on to the next page, it's been quite an aggressive rally. It's not maybe as quick as we've seen in periods during the financial crisis or COVID, but certainly it's been violent. And I think if you had tried to time the market, you might have been caught out. But if you look under the hood, it hasn't, as I say, been very easy. There've been many sectors that performed very well in the beginning and those that didn't going forward. So if we just look at the first quarter of the year, really from the end of 2024 to around the 8th of April, best performing sectors were really the defensive sectors. So things like telecoms, beverages, insurance, utilities. And as you can imagine, more value, low beta orientated stocks would have done well. Our fund massively outperformed during that first quarter. Stocks that didn't do well, you get it, high tech growth, high beta stocks, tech, semis, consumer discretionary, media, etc., etc. But things did change. And if we just move on to the next slide, you can see that the winners from the previous quarter had actually now become the losers, and the stocks that have really performed from April to end of July, August have been, as I say, the stocks that really underperformed during the first quarter of the year. So things like the semis, and within that, it's obviously Nvidia and Broadcom and AMD and things like that. And then the software names, which have done exceedingly well. And the underperformers have been insurance and telecoms and the like. So the low beta defensive names. So really difficult as a fund manager when you have a certain positioning that massively outperforms and then underperforms, and arguably has really very little to do with earnings, but more to do with style. So if we just move on to the next slide, please, Dan. So talking about style, and as you've probably listened to me many times before, I always put this graph up, but for people who haven't seen this, this is the relationship between value and growth. So the blue line depicts when value underperforms growth, and as you see it going down. So for example, from 1974 to 2007, as the blue line goes down, it means value is actually outperforming growth. We saw a temporary period in 1998 where we saw the tech bubble where value has a massive outperformance, and then it capitulates in 2000. And then from 2007 really onwards, where the blue line starts moving in an upward trend, that is when growth outperforms value. And again, you see the accentuating periods of time where we see a big dislocation, for lack of a better word. And that massive outperformance comes during COVID, where you see the huge spike. And then again, a tracement during 2020, where interest rates go very high very quickly. And then now, the period that we're kind of in, starting in 2023, 24, where you see growth massively outperforming value. And then we see a little retracement and then back to where we are as the presentation starts in August 2025. A few points, the little red dots are every time that I've actually presented at a conference with BCI. So the first one was in Feb 25, and I talk about déjà vu, where the relationship or the valuations between growth and value are really outstretched. Subsequently, we saw retracement where we thought, or I did think, this could be the big move back of some kind of trend line in value where we just get back to trend, which would be the little black dotted lines underneath that. And then, bam, another big discrepancy in returns between value and growth, where we are to now in August 2025. So I just think it's good food for thought just to see, the big differentials and kind of the relationship in terms of valuations. I think we can now move on to the next slide. So deja vu, as I said in February, markets are high and valuations are high. And although one of the big outliers has to be the growth index, it's to be argued that actually the whole market is high. If you go back to 2017, you can see kind of the relationship between all of these different styles. But interestingly, a big move in growth, and that goes back to about 2007, has been the divergence, not necessarily in earnings growth, but actually in multiple expansion. And so a lot of the outsized performance in the growth index certainly has come from massive multiple expansion, and that's quite worrying, particularly if you do get periods of stress. You do get periods where growth can capitulate quite quickly. If you look at the value index, one would argue, on 15 times in 2017, it's only on 16.2. It hasn't really re-rated that massively. And again, that is kind of the argument, is you want to be in sectors and stocks where if you do have downside, turbulence, that you do have some kind of protection. Interestingly, I put the Credo Global Equity Fund on this graph as well, and it just shows you how the valuations of the equity fund are, and we very much do track value, and that's why when I do present, I do spend a lot of time on the relationship between value and growth, because essentially the Credo Global Equity Fund has much of a value bias, although we have outperformed the value index quite handsomely. And again, that is because of quite a nice qualitative overlay within our stocks. If we move to the next slide, Dan. I think this graph is actually probably one of the most important graphs of the presentation, and it's quite fascinating, and I didn't realize this until I actually did read this little piece of research. So what we have here is the MSCI World Sector Style Valuation Index, and it kind of shows you the 12-month forward PE relative to the last 20 years. So if we just break down what we see, you see the gray kind of brackets, which shows you valuations that are within the 10th and 90th percentile. Then you have the shaded blue lines, which is the interquartile range, which is where you would expect the kind of sectors to trade. Then you have the little gray box, which is your median, which is your average, and then your current valuations. And this is what's quite startling, is when you go through all of the different sectors and style within the market, you find that a lot of them are outside of the 90th percentile of their range. In other words, they're trading at some of the most expensive valuations that they've ever traded at. So, as you would imagine, if you look at IT, way above its norm, growth, again, way above, etc., etc. But what I found quite interesting is even value. You would think that I would be punting value quite heavily here. Even value arguably is trading outside of its 90th percentile in terms of valuation range. But the only comment I would make about that is that when you do get a re-rating and you have value that trades between 10 and 14 times, to get a re-rating, you might see a stock drop back to 12 times, 11 times, which is 15, 20% drop. When you're dealing with high beta stocks in growth and technology and the like, where the norm has potentially been around 18 times and the PEs are now 27 times, you have a 40 or 50% correction, and that's the difference. And that's what you need to actually look out for when you're playing high beta stocks, high growth stocks, and highly valued stocks. And so I think it's quite a useful slide, and it just again reinforces the fact that at current levels, markets are expensive, and one needs to be pretty cautious out there. Next slide, please. So in February and in May, I spoke about AI indigestion and the risks to the market. And there's no doubt that the AI spending has absolutely continued. We look at some of the big four players in the market: Meta, Google, Microsoft, Amazon, and they just keep spending more and more and more. 400 billion, in capex just in 2025, which is great actually for the AI kind of move, and it's great for stocks. And just to put that into perspective, AI capex this year has added more to GDP growth than consumer spending. So it's definitely propelling the economy, it's propelling stocks, and obviously there are significant beneficiaries of this. And the real question is, how long can this carry on for? And ultimately, is this going to be translated not only into higher earnings, but to more efficiency? And is it just a race to the bottom? Next slide, please. I keep, in the back of my head thinking about the DeepSeek moment and what could actually unrail or derail the AI consumption and growth trend. And I've just put up here the basic cost of language learning models and the differential between those in the States or US and those in China. And so you got Claude, on the far right side, where it costs you about $15 to consume some of their tokens and their language, compared to ChatGPT and Gemini and the like, and Llama. And then you have the Chinese LLMs, and the most expensive one there is DeepSeek, and it costs you about $2. But interestingly, under that, you see a lot of speckled little blue lines or blue dots. Those blue dots are a whole host of companies, some of them which we do know, the likes of Alibaba and ByteDance and Baidu. But there are, a number of these new unicorns that are popping up in China, which we've never heard of. And it just kind of worries me that at some stage something comes out, or we have new technology, and everyone realizes that the race to the bottom actually isn't just spending billions and billions on capex, and that you can actually achieve it much cheaper and much quicker. And this does put a risk to a lot of the US stocks out there. So next slide, please. So we talk about here the Mag 7, and maybe it is too early to say who the winners are going to be, but what I've tried to show in this graphic is, the performance of Mag 7 in 2024, and you can see the big blue lines of the stocks. They all did very, very well. And certainly from April onwards, the market has really been lifted by the performance of the Mag 7. But if you look actually at the year-to-date performance, it's interesting to see that Tesla, Apple, and arguably Amazon actually haven't actually hit their highs and are still down for the year. It's really only stocks like Alphabet, Microsoft, Meta, and the big performer being Nvidia that have done very well. And it's, again, quite interesting to have to analyze these businesses and to work out who are the winners and who's going to ultimately win the race. And so you have companies that are spending massive amounts of capex. And as Elon Musk basically said, companies like Oracle actually don't have the balance sheet to compete. So the quicker they spend and the more they spend, the bigger the moat. And the bigger the moat, obviously, the more defensible the businesses. So it is obviously very important that these businesses do spend to get to a level. The biggest beneficiary, however, I would caution, is Nvidia, because it's jammed today for this business. But trees don't grow to the sky. $4 trillion market cap. I'm just not sure if it can continue growing at the same exponential rate that it has in the past. So one stock that we don't actually own in the portfolio. So moving on to the next slide. Risks to the market. There's lots of risks, and I try to point them out again in my presentation in May. The biggest risk at the time was tariffs. And one would argue, Trump's actually done a pretty good job. There are a lot of naysayers and a lot of haters out there. But if we move on to the next slide, we can maybe trace some of the tariff history. Quite a complicated slide, but if you just bear with me, it actually talks about early days, the progression, the blue line, where we talk about early in February, tariffs on Canada, Mexico, and China. and then how it progresses again to additional tariffs on China. And then Liberation Day, where you see big spikes in the level of tariffs being imposed across the board. Then reciprocal pauses, a deal with UK, China, and it's quite complicated. But the point that I really want to make with this slide is that the US has, the top trading partners on the right-hand side of the slide being China, the EU, Mexico, Vietnam, Ireland, Germany, etc. And if you go through that list, with the exception of China, he's actually done a trade deal with pretty much all of those countries. Even with China, they have a 30-10 tariff regime, but it hasn't been implemented. And one way argue, for all Trump's kind of idiosyncrasies, he's actually done a great deal for the US. He's managed to get non-reciprocal tariffs. In other words, although they have imported, some kind of inflation arguably into the US is not paying anything to export its own goods. So it's actually quite a good deal. But more importantly, I think, which brings me on to maybe more of a macro kind of debate or question, is the impact of these tariffs on the US inflation. And what you see with the black line at the bottom of this diagram is that based on actual trade, the actual tariff that has been implemented, or the value of the tariff that has been implemented in the US is only about 9%. So we haven't really seen the full effects of tariffs being implemented on companies and on the US economy. And that's kind of worrying because, yes, although a lot of the S&P stocks over the last quarter have blown their numbers away, there may still be trouble ahead, and it's something certainly to monitor, not only from an earnings point of view, but certainly from an inflationary point of view. Next slide, please. So this, again, brings me on to the same question in terms of interest rates. We talk about the market expecting interest rate cuts later this year. In fact, somewhere between 2 to 3 cuts. And Trump every day is blasting Powell and talking about how he's slow and he should be fired. I quip there that if you just log into Twitter, you'll know whether he still has a job or not. But we are precarious highs, stocks at all-time highs, house prices all-time highs, Bitcoin all-time highs, the money supply, national debt, and inflation is way above the Fed's target. So the market's crying out for interest rate cuts. And if we don't necessarily get those cuts, we could see a little bit of disappointment in the market. So certainly something to monitor over the next few months in terms of the inflation rate and how quickly the Fed can react if it needs to. Next page. In May, I put this slide up and it was talk about a recession. And at the time, sentiment in the market was very bearish, and there was a 45% chance of a recession. You had Jimmy Dimon and you had Larry Fink talking about, doom and gloom. And if we fast forward now to where we are in August, and we just move to the next slide, a poll by Polymarkets puts the chance of a US recession in 2025 now at 13%. So markets are quite relaxed. Investors are quite relaxed. There's quite a big bullish sentiment out there, and clearly markets have reacted very well and are trading at all-time highs. And it's always periods like this where one needs to be a little bit wary and cognizant of over bullishness and a little bit of frothiness in the market. So, it's just a heat of caution going forward. Moving to the next slide. Again, risk, geopolitical risks, and I put this slide up in May. Interestingly, spoke about the US, Israel, and Iran as a potential risk. Well, quite bizarrely, that came and went in 12 days. But what was interesting there is, although the oil price spiked on the first day of the war, in subsequent days it actually settled. And although obviously Iran didn't close the Straits of Hormuz, it didn't really spike the oil price at all, and it just kind of gives me the idea or the belief that we can throw a lot of negativity in terms of geopolitical risk, but the market deals with it pretty well. Russia, Ukraine, well, next few weeks we'll see, maybe there will be a settlement that will be very bullish for equity markets. And China for now seems like things have settled down, but the risk of an invasion of Taiwan is still very much something that one needs to be cognizant, although it's a long way off and something that doesn't look like it's happening anytime soon. Next slide, please, Dan. So what do we do? What I've been kind of articulating for the last 15 odd minutes is that markets are expensive, sectors are expensive. There's a lot of bullish sentiment in the market. And so as a stock picker, that has to be in the equity markets, what do you do? And so we do what we do all the time. We keep calm, we carry on, and we look at long-term focus. And what we do is try and buy high quality businesses at relatively low valuations. And if we just maybe move on to the last slide for the day, this is a snapshot of our global equity fund as of July 2025. Maybe if I just start on the geographic allocation, 61% US, which is more or less in line with the MSCI index. You'll notice that we have a heavy allocation towards the UK and Europe, being 19% in the UK and 18% in European stocks. One would argue that these are not pure UK or European stocks, although obviously we do have a few UK-centric stocks in there. But these are global leaders and great quality businesses. In terms of sector allocation, we remain overweight financials. Within the financial basket, a lot of insurance, which hadn't done well over the last 3-4 months, although banks have, but we've been a little bit underweight banks. Specialist financials have actually done pretty well. We are underweight information technology, as you would imagine. But maybe what the little wagon wheel doesn't tell you is that we do own 3 of the big Mag 7, being Microsoft, which is actually our top holding at the moment, mainly because of performance. We had built a position in Alphabet last year, and that's come to fruition, and that's performed very well. And we also own Meta, which isn't in our top 10. So a little bit of exposure to IT, but certainly underweight. And then quite a diverse basket of other stocks. And then just a few comments on the top 10. So as I mentioned, Microsoft being our biggest holding. Interesting to see the presentation from our last presenters where they had Safran as their biggest holding. So we have MTU Aero Engines, which is a competitor to Safran, as our 3rd biggest holding in the fund. It's a great German business, civil aviation, and we actually think it trades at a significant discount to the peer group, being Safran, Rolls-Royce, and GE. A lot of the other stocks you would have seen from our fact sheet when we put it up in May. So there haven't been any significant changes there, although Ryanair has made it now into the top 10 again through strong performance, and British American Tobacco has performed very nicely over the last few months. So that's really it from me. I think, Dan, if we can maybe just put up the results of the poll, and then I'll leave it to Eugene.
Thank you. I think Dan is going to pop it up just now. It should be very interesting. I wasn't allowed to vote, but it's fine. There we go.
Right. Okay. Fair enough. So I think the market, yeah, people are generally quite bullish. Bullish to neutral, fine, which is great. If we move on to maybe question number 2. Yeah, okay. Quality, excellent. Slide number 3. Okay, I think this result is quite interesting. And then just maybe slide number 4 in the interest of time. Okay. I think maybe we're talking to a emerging market audience here, but again, quite interesting to see that's where the value comes, where people are positioning. But anyway, I'm going to leave you now. Thank you very much for your time today and for giving me the opportunity to present once again. And hopefully you found that quite informative.
Jared, just before you go, I think those polls are very interesting indeed. We are a little bit behind time, but we're going to catch up later during the day, so it's not a problem. Very fun question from one of our audience members, and I think, it's top of mind for a lot of us. So the question is, portfolio managers from many managers have been warning investors since COVID that the rebound, or after the COVID rebound, to expect more depressed returns. Yet markets rallied or substantially while debt is at an all-time high. And if I can maybe add to that, if you look at USA especially is at an all-time high. Who to believe? Your comments. Do we go
Yeah, I mean,
guns blazing or do we remain
it's a difficult
cautious?
one to answer. Yeah, look, I guess it's kind of, where do you put your cash right now? I mean, I would argue that the bond market actually isn't unattractive right now on a relative basis. Yes, you may be getting quite low yield, but when you look at risk-adjusted returns, I think one would argue, and I'm not an asset allocator, that you probably want to be in the bond market over and above the equity market, just from as I say, from a risk point of view. We don't have the luxury of asset allocation in an equity fund, and that's why I want to be in, as I say, defensive stocks right now, value over growth, because I do think you have downside protection, and we've seen it time and time again during COVID, during the financial crisis, and again during the beginning of this year when we had, deep sea liberation day kind of moments.
The very first graph that you showed on the trends versus value versus growth when they underperform, outperform. And I mean, you just don't know. And we've seen that especially over the past year. But what I can tell from experience is that your fund actually dovetails very well with quality managers. So if you're not sure, you look at diversification, then look at the Credo fund. It can work to your advantage with times. Jared, thank you so much for joining us this morning. Always great to have you on these sessions. Insightful as always. Thank you so much.
Pleasure. Cheers, Eugene.
Thank you. Right, we're moving on to global property. And joining us online, ready to go, is Anil Ramji from Ses Vakili, the property experts. Anil, I'm going to give you a very tough opening. I mean, we've been advocating for clients for a while now that global property is a good diversifier in client portfolios, and especially in a rate cutting cycle, you might see a lot of excitement. But returns came in bumps.
Yeah,
Um, and investors start to wonder, should we still have global property in portfolios? So looking forward to your views and telling the story from the experts. Yeah, thank you.
excellent. Thank you, Eugene. Can you hear me clearly?
Absolutely fine. Thank you.
Thanks, Eugene. Good morning, everyone. As Eugene said, my name is Anil Ramji. I'm from Ses Vakili Capital, and I'll be chatting to you about global property. Just quickly, an update on Ses Vakili Capital. We are a specialist listed property asset manager offering 3 strategies, a local, global, and a flexible property fund that have delivered top quartile performance. We currently manage approximately 19 billion in assets, and the business remains owner managed with an investment team that has an average of around 16 years of experience. So just a reminder, the local property index, or the OP, has around 54% see-through offshore exposure. But most of that is in the UK and Central and Eastern Europe. What the Global Fund gives you is access to global developed market real estate. So majority of the REITs are located in the US, about 70%, followed by Europe and Japan, but you also have access to UK, Australia, Singapore, Canada, and Hong Kong. More importantly, the global space offers you a high degree of choice and specialization. So just to give you some history, about 25 years ago, the global REIT market was very similar to the South African market currently, where about circa 90% of the total market cap was concentrated in the core sectors of office, retail, and industrial. Fast forward to today, non-core sectors such as apartments, single-family resi, data centers, now account for 60% of the total market cap and 95% of the number of listed stocks in the benchmark. You now have more than 16 different sectors to choose from, and the ability to invest in a certain sector in a certain location. So I'll give you an example. If you wanted exposure to apartments in Germany, or offices just in Manhattan, or data centers in Singapore, you can find a REIT that focuses specifically on that property type in that location, which gives you that high degree of choice and specialization. Our strategy uses what we call the concentrated thematic approach to portfolio construction. So concentrated in that our fund holds up to about 60 stocks compared to the benchmark that has more than 350 opportunities. And thematic in that we research, we debate, we identify key themes that are happening globally, and we check those themes against real estate fundamentals. So things like supply and demand, vacancy rates, rental growth, with the ultimate objective to be overweight stocks or sectors that we believe will be beneficiaries of those themes, and then to be underweight stocks or sectors that we think will be disrupted by those themes over the medium to the long term. So a question we often get is, why does active management matter in the global REIT space? So firstly, different real estate sectors are driven by very unique macro and microeconomic factors, which has actually led to a wide gap in total return. So for example, in 2024, the performance difference between the best and the worst performing sectors, so specialty versus industrial, was around 54%. And the gap between the top and bottom regions was 37%. Also, REITs tend to be underanalyzed. The average number of analysts per global REIT is 6 analysts per global REIT compared to 16 analysts per global equity. So obviously this can create pricing inefficiencies and opportunities for alpha generation, which actually shows in the performance. As you can see from the table below, REIT specialists have historically outperformed generalist investors anywhere between 80 basis points to 2.2% annually, depending on the time period. So what we're trying to say here is that these pricing inefficiencies with those sector and regional return differences highlight the opportunity for active managers to enhance returns through both sector and stock selection. So Eugene, to answer your question, let me walk you through why we believe global REITs remain a compelling component of a diversified portfolio. So firstly, interest rates. We are in an environment where central banks are shifting towards easing, and lower rates translates into lower debt costs, which directly supports REIT cash flows. Secondly, REITs are often considered a hybrid between equities and bonds. Their earnings are supported by stable, predictable cash flows from contractual leases, which provides that steady rental income and the predictability of fixed income, but also gives you growth potential. Thirdly, diversity of sector and regional diversity, which I spoke about earlier. Fourth, inflation hedge. Most leases have an annual rent escalation, which is a fixed rent bump anywhere between 2 or 3%, actually going up to 3 to 4%. And in other cases, the rents are inflation linked, which provides that natural hedge against inflation. But also remember, inflation increases the construction costs, which increases values of existing assets. Fifth, REITs have a relatively low correlation with global equities. Our calculations show a long-term correlation of around 0.75, which does provide diversification benefits. Then in terms of property fundamentals, and I'll take you through this a little bit later, demand remains robust while supply is limited in many sectors. This imbalance is obviously creating landlord pricing power, which is very crucial for sustained rental growth going forward. And then finally, valuation. REITs today are historically attractive, trading both at discounts on both an earnings multiple and a net asset value. So when you put all these factors together, global REITs are pretty well positioned going forward. So over the next few slides, I'll be taking you through some of the key themes in our portfolio at this point in time, starting off with seniors housing. So senior housing is an example of the necessity-based real estate theme, which is driven by a secular trend of an aging population, especially in the US, Europe, and Japan. So no matter if consumer confidence goes up or down, or if there's a trade war or not, or if there's tariffs, people are getting older. And in the US, that age group of 85 years and older is expected to grow at 4.5% CAGR through 2030, compared to almost flat growth during the 10 years prior to 2020. So the chart in the middle also shows that supply of these senior housing facilities is now 90% lower than its peaks at the end of 2017, and now only represents about 1% of existing stock. As shown on the graph on the right, given the strong demand and the almost zero or very little supply, occupancy rates have already started to recover and are around pre-COVID levels of 90%. But because of those fundamentals, we think occupancies continue to trend upwards towards the 95% level, which then leads to rental growth of more than 6% and same-store net operating income growth of 14% going forward. Data centers. So Jared had the same slide, but I'll just add to our view on it. So, data centers is driven by the theme that we have, which is AI and big data. So just remember, taking a little bit of a step back, the first phase of demand for data centers was driven by the massive amounts of data being created. So think about all those TikTok and Instagram videos that needed to be stored somewhere. You combine this with the adoption of cloud computing, which led to very, very strong demand. Now we have this new trend of AI, which brings even greater potential, especially because AI requires significantly more computing power. So there was a Goldman's report out last year, which showed that the average ChatGPT prompt uses 10 times more power than a simple Google search. So it was 2.9 watts of electricity for the ChatGPT prompt versus 0.3 watts for the simple Google search. And remember, data centers are leased based on power usage and not square meters. So, a lot of people say that's why you shouldn't bother with please and thank yous when using AI prompts. I still use them just in case the machines take over the world and they remember who was polite to them. But what we use as a proxy for demand, we look at the amount of money big tech is spending on CapEx. Similar to Jared's slide earlier, if you look at the big four major tech companies, they have increased their CapEx spending by 60% from last year to about $361 billion for 2025. So you have really, really strong demand coupled with a lot of supply constraints in the sector. So think about limited power availability, limited land, regulatory factors such as GDPR in Europe and construction constraints in Singapore, which have pushed vacancy rates down to about 2% in core markets, especially across the US, Europe, and Singapore. So going forward, we anticipate rental growth of more than 6% annually over the next 3 years, with rental reversions reaching as high as 50% in some core markets, especially in Singapore. Moving on to single-family rentals, which is driven by the demographics or demographic dividends theme that we have. So what do I mean by demographic dividends? This is a shift in the age structure of developed economies, particularly the millennial generation, which is now the largest demographic group with approximately 213 million people in the US and Europe. These millennials, so they aged anywhere between 29 and 44, are at the age where they're starting families and moving out of their apartments in the big cities into freestanding homes. However, there's a big problem with affordability in the US. The average house price is up almost 50% since 2019 to around $406,000. But also, the 30-year mortgage rate, which is what they finance with in the US, is up from 3% to 6.7% over the same time period. So millennials are forced to rent because it's 27% cheaper to rent than to buy. So the strong demand has kept occupancy rates at high levels, about 96%, which is underpinning consistent 4 to 5% rental growth for the sector. Moving to retail. So, the resurgence of retail. If you had to look at a similar slide that we probably had about 5 years ago, we would have said death of the mall. But there has been a resurgence of retail fueled by a surprisingly resilient consumer. Again, looking back at Jared's slides, that probability of recession was high. It just never came. And the consumer remains very, very strong. So e-commerce growth or e-commerce continues to grow. But what retailers have realized is that the actual brick and mortar store remains core to profitability. And that's actually led them to sort of embrace the omni-channel strategy. In addition to all of that, what happened during COVID or the pandemic, it also sort of accelerated industry consolidation amongst retailers. So the weaker retailers, such as JCPenney, Bed Bath & Beyond, Debenhams, they were pushed into bankruptcy. While the really strong operators, Sephora, Primark, Best Buy, they expanded into prime retail space. And remember, most of the listed REITs actually own the really good prime retail space. So you got really strong or robust demand. You combine that with historically low levels of supply. So look at the middle graph there, only 20 basis points of total stock of supply of total stock for shopping centers, and actually negative supply in the mall space. Basically malls completely closing in the US, or malls being converted into universities. We've seen some cases of that, or other uses. This has actually pushed retail vacancy rates close to historic lows of around 4% in the US and Europe. And we expect the strong fundamentals to continue and to lead to about 4 to 5% rental growth in this sector. Moving on to how we positioned our valuation and outlook. So starting off with how we are positioned. So on the left there is our regional weight relative to our benchmark, which we limit to a maximum 2% underweight or overweight. And we do this as a risk mitigation tool. We don't think we're good at forecasting FX rates or even political stability for that matter. We believe we have a competitive advantage in choosing stocks and sectors, and that's where we show our conviction. So as shown on the graph on the right there, you can see we overweight data centers, healthcare, single family rentals, and malls, which is directly in line with the core themes I explained earlier. And on the right hand side of that graph, on the right hand side of the right graph, you can see we still remain very cautious on the office sector. So we've discussed the trends and the themes we invest in, but an important step in the process is assessing those themes against real estate fundamentals. So on the left, we have occupancy rates, which we use as a simple proxy for demand. So as you can see, retail is currently at all-time highs, apartments are stable, and industrial actually came down slightly from its 2022 peaks. However, offices continue to lag since the pandemic, dropping to about 86% occupancy rate. That being said, there was a slight pickup in Q3 2024, which could indicate that the office occupancy actually have bottomed out. Now, overall, the REIT sector is operating at about a 93% occupancy level. However, what gives us further comfort that these occupancy rates will remain strong and keep the bargaining power in the hands of the landlord is the supply picture, which I show you on the right there. So supply in all sectors are down from 2022 peaks, anywhere between 33% lower for life science to 93% lower supply for offices. So you got this improved supply outlook, which suggests that REITs are well positioned to continue growing rentals by more than inflation going forward. Moving on to balance sheets. Remember, REITs or property is a leveraged asset class, so balance sheets are very important. Focusing on the US, which accounts for 70% of the overall market. If you look at the LTV ratios on the left there, they have declined from just over 40% 2 decades ago to current levels of around 33%. You can see it did drop to 26% just before the rate hiking cycle started in 2022. And since then, as interest rates went up, cap rates expanded and property values have adjusted downwards, ranging anywhere between a 6% decline for malls to a 36% drop, 38% drop for offices since their 2022 peaks. However, if you look on the graph on the right there, if you look at 2024 in isolation, it was the first year we saw property values go up again by about 5%. And we expect this to continue this year with values up again in the low single digits for 2025. And then valuations. So in terms of valuations, the sector is very attractively priced, both relative to historical averages and the underlying assets or intrinsic value. So looking at the price to FFO or price to funds from operations or a PE ratio for the sector. It's currently trading at about a 15.9 times multiple, which is lower than the long-term average of 17 times. More importantly, we believe earnings growth is actually expected to accelerate going forward, with about 5% growth in 2025. And given that supply and demand that I spoke about earlier, we think that earnings actually accelerates to about 6.5% next year. So you have a multiple gap relative to history and accelerating earnings growth. The graph on the right shows price to NAV for the different sectors, ranging anywhere between a 19% premium for the healthcare sector to a 30% discount to NAV or net asset value for the hotel sector. And then finally, how are we thinking about total shareholder return? So kind of linking everything together, global REITs offer you a 4.3% forward dividend yield. And we've modeled approximately 5.6% dividend growth over the 12 to 24-month period. Then we assume the US 10-year bond 12 months from now of about 4.2%. This is a pure Bloomberg consensus number. We don't have any competitive advantage trying to forecast the 10-year bond yield 12 months from now. But if you put all of this together, you could expect anywhere between expect about 11% total returns in USD over the next 12 months. And then we can expect anywhere between 9 and 10% over the longer term, which is very much in line to what the sector has delivered over the long term, which is in between the return from equities and the return from bonds. Thank you very much.
Aneel's insightful indeed, and I think your slide 6 did definitely answer my question as to why global REITs in the very last slide. I'm going to take one very quick question from the audience. Is your sector exposure within property, for example, residentials, industrials, storage, etc., capped to avoid concentration risk, or do your exposures reflect pure conviction irrespective of your benchmark?
Yeah, good question. So in terms of the sector allocation, we have no limits. But to control concentration risk, what we do have is a maximum 3.5% maximum overweight on a stock specific limit. So we cannot have more than 350 basis points more than the weight in the benchmark on a stock level. But on a sector level, no limits, and that's where we show our conviction.
I'm going to take one more question because it does speak to why we include property as diversifier in client portfolios forward-looking. And the question, how would a slowing US or potentially a recession affect the property sector?
Good question. Remember what I mentioned about different property sectors having unique macro and microeconomic factors, and how we think about it is that because we have 16 different sectors to choose from, you can choose sectors that actually outperform or have historically outperformed in recessionary environments. So I'll give you an example. In a recessionary environment, we assume that interest rates would come down. And if you think about that, you would choose sectors that are the most defensive, and sectors that are the most defensive are sectors like healthcare or the triple net lease sector or the gaming sector. The gaming sector has a 30-year weighted average lease expiry profile. Triple net lease has a 10 to 15-year weighted average lease expiry profile. So we would overweight those defensive sectors and we would underweight the hotel sector, because the hotel sector is obviously driven by economic growth, and that has a 24-hour weighted average lease expiry profile because you go to a hotel and hotels are sold per night. So that's how we can shift the portfolio given our assumptions of where the economy goes forward.
Aneel, still a very compelling argument. I'm going to park it there. Thank you so much for coming on this morning and your time. Always great to have you on board. And we know by now, you are the property experts. If you want to know anything about property, they also manage local property funds. Speak to Sesh Fakile. Aneel, thank you so much.
Thanks, Eugene. Thank you very much, everyone.
Right, we are moving on to global equity, or more specifically emerging markets. If we look at Jared's last poll, where do clients see returns coming from? in time to come. There's a very high allocation to emerging markets, but I suspect, obviously that included SA equity. But what about other emerging markets? And joining us now from GQG Partners is Kevin Austin. Kevin, good morning. How are you?
Good morning, Eugene. Thank you for having me on. I'm doing well. Thanks again for inviting me to present today.
Always great to have you on board, Kevin. You can start sharing if you are ready.
I'm ready. I'm going to, slight correction, I'm going to spend a little bit more time. We're global equity managers. I'm going to spend a little bit more time.
Yeah.
In fact, I'm singing from a very similar hymnal than Jared was today, given our views on the market and where we are positioned. It does, sort of translate into the emerging markets portfolio as well, but primarily our developed market portfolios, which have migrated to a much more defensive. I think overall we're much more defensive than we were, call it a year, in fact, 6 months ago even. We have migrated to a much more defensive position, and those who are sort of watching our performance and watching us closely know that it has been a challenging period, and specifically from a relative perspective, given the positioning that we have in the portfolios being much more defensive. And just to remind everyone, we are very much adaptive. We have a very adaptive process to managing our portfolios, where we move to where we see the best opportunities in the marketplace on a forward-looking quality basis. So always looking for quality stocks, but we believe quality is very much a dynamic of the period that you're looking at. And so here's what we sort of have, throughout the first part of the year. And if you sort of look at this from the first 15, 16 weeks of the year, very similar charts that what Jared had, where you had a lot of noise around, sort of economic data, the soft data starting to turn negative towards the beginning of the year. And then you had obviously the DeepSeek announcement, which was sort of a seminal moment with respect to artificial intelligence and sort of indicating that, there might be a different way to do things, i.e. that there might be more of a peak, or we might be closer to the peak of that. It's obviously hard to call that. But the point being is that was a very important data point in our view. And so we started to get much more defensive sort of in the beginning of March, late February, beginning of March. And that looked very well. Our developed market portfolios were outperforming during the first quarter, again, during the first 15, 16 weeks of the year, as we started things to deteriorate and react to those negative data points, including all of the sort of rhetoric around tariffs and the technology. But then, around sort of the end of April, things reversed very rapidly. I don't know, I've been doing this, I think it's getting close to 30 years now. I can't remember a reversal this sharply within sectors like this. Maybe it was similar in COVID or going back farther. But this has to be one of the most significant reversals in the marketplace. I mean, you look at this swing from minus 21, a 57 percentage point swing just in the technology sector of the S&P 500. And so the biggest reversal in those stocks and those sectors that were the beneficiaries, AI being obviously technology, communication services, and industrials. People forget, industrials are benefiting immensely from all of this CapEx spending in terms of electrical distributors, and those types of companies that are all taking advantage of this. And to us, we look at this, most specifically in terms of valuations. And let me go to the next slide here. In terms of valuations, where they're starting to get back in the range of where we've seen sort of bubble mentalities happen. If you go back to sort of late 2021, the technology companies were over-earning, and the amount of multiple expansion that we've seen since sort of the lows of the market in 2022, the S&P 500 is up more than 75%. However, earnings are up somewhere in the range of 20%. So we've seen a lot of multiple expansion sort of pushing the market higher, not so much translating to fundamentals, which has us somewhat concerned. I mean, this was done, I think, sort of a few months ago. And so we're now back to 23 times, I think, on a forward earnings basis for the S&P 500, which again is getting in that rare air territory. There's a lot of air underneath the market, and that's got us concerned in terms of even if the earnings come through, and I'll talk a little bit more about that later, but even if you see the earnings come through, this is painting a very rosy picture that all things, and if you don't get back to sort of a double-digit earnings, I mean, I think the market expectations now are sort of consensus expectations for 6, 7, 8% growth for this year on a year-over-year basis. if you don't reaccelerate to mid, sort of, teens types of growth rates for the S&P 500, it doesn't seem likely that these sort of multiples are going to be sustainable on a go-forward basis. And just looking at it from another way in terms of where interest rates are. And, we're not making big predictions about interest rates in terms of not any more than any other sort of economist would do, but, we do believe that they are going to be sticky given all of the inflationary the pressures on the market. We just saw the UK numbers come out overnight, and I think they're looking at 3.8% inflation, which is not, I think, what people expected. And so they may be pausing interest rates. We're starting to see some, continue to see sort of inflationary pressures, and the 10-year really hasn't budged. Even though the Fed could reduce interest rates, that doesn't mean automatically the 10-year. In fact, they've been fairly resilient in this rate environment. And if you look at longer term bonds, they're all much higher. The 30-year bonds across the board globally have been significantly higher than they were, 6 months, a year ago. And so they are being much more sticky. And then if you look at valuations from this perspective, this is the earnings yield on the S&P 500. We've never, I shouldn't say never. The last time I think this crossed, you'd have to go back to 2001, 2002 timeframe when interest rates were on their way from 6.5 to 4.5 during that time period. And so it's been a very long time since we've seen the earnings yield cross the 10-year treasury yield. That is, to us, a very significant data point. I mean, if you think, the narrative back, a few years ago was TINA, right? We all remember that acronym. There is no alternative. You have to own stocks because you can't, because bonds aren't yielding anything. The yield is essentially zero. That's not true anymore. 4.3, call it 4.3 to 4.5 is an attractive yield to many people, especially in light of S&P 500 valuations. And so there is another option now for people outside that don't want to take on equity risk, or the translation of that is that you're not getting paid. There's no equity risk premium to be had on an earnings basis. But then also just the simple discounting math of it, right? If interest rates are going to remain high, you would pay less for those future cash flows, i.e. growth stocks are worth less. And that should be, back, again, a few years ago, everybody was sort of, everybody was justifying those high multiples in the stock market because interest rates were low. Well, interest rates aren't low anymore. So how do you justify, a higher multiple than what we were paying years ago for stocks? And then just look at one more sort of metric in terms of, this is our friend Warren Buffett's, his sort of moniker of the market cap of the S&P 500 relative to gross national income. And this is way beyond where we were back in the late 90s, and similar to where we were back in 2020, 2021, where his view is you're playing with fire. There's just not a lot of margin for error, and we don't believe you're getting paid to take risk. And so we want to migrate. We're populating our portfolio with opportunities where we can see the most visibility in earnings with the least amount of valuation risk. Companies that are trading like utilities and consumer staples that are trading at sort of their long-term historical average multiple. So even if you do get a market correction, as long as the earnings come through, and it's not a big leap of faith that a company like AEP or a utility company, wherever that may be, is going to hit its earnings estimates. They tend to be very stable and being able to deliver on that, i.e. even if, what we're sort of banking on and what we look for, and typically what we always want to anchor on in terms of our underwriting a stock is a low double-digit, high single-digit rate of return. And that's, that's yield, that's dividends plus earnings. And so all of the stocks in our portfolio get us to that point. It's just those ones have not been sort of the trade du jour, if you will, over the last several months. And just look at it on a slightly different metric in terms of the technology versus the S&P 500. That's the same sort of forward earnings on a forward 12-month basis. Pretty frothy levels, again, getting tapped. But I think what's also very important is looking at it on a price to sales basis. That's the chart on the right-hand side. You can see stocks are trading at very frothy levels. And I think if there's one thing that's consistent about sort of valuations, it's price to sales metrics. When price to sales metrics get, around that 10 times, call it 8 to 10 times range, the probability for excess returns is almost zero. It's very, very bad. It's very hard for companies when they become that much of a market, like NVIDIA, where they're almost, I think, over 50%, even more now in terms of the profit pool of the semiconductor industry. It's very hard for those companies to deliver excess returns. And there's, I think Adobe, I've got a chart later in here showing Adobe where, they were trading at, I think, something like 18 times price to sales 10 years ago, and they delivered 80% revenue growth over the subsequent 5 years until this year. But the stock went down a lot because it was overpriced. They delivered decent. It did slow. I mean, that is granted. The growth rate slowed, but they still delivered it. I think it went from 10 to 15%. So it went down. Still good revenue growth, but the stock underperformed the market dramatically in that period just because it was overpriced to begin with. And that's kind of where we see, even if these companies deliver on their revenue and earnings targets. And oh, by the way, all of the big 4 or 5 hyperscalers, mega cap stocks, their revenue growth is decelerating, not accelerating. It's decelerating, not by a lot, but again, it's decelerating. I think most people would think they're doing quite well, and if things are going gangbusters, that they should be on an accelerating growth trajectory, but that's not the case. And so let's take a look at this. This is a chart, a table that we bought from Goldman Sachs. So this isn't any of our data. But they present 3 scenarios here in terms of their earnings estimates for this year. Recessionary scenario of 225, their baseline scenario of 268. I think it's down to 262 now. This is back as of May. And then the bottom-up consensus market expectations, which I think are a few points lower, a few dollars lower now than when this was done back in May. And then, we were trading around that 22 times back in May. So now we're sort of at a range where there are no more sort of green areas. There's some slight green ones. If you get the sort of rosy scenario, the bottom-up consensus, and you get, you get a multiple holding. But if you go back to, if you go to sort of the middle of it, maybe let's call it the middle scenario there, where we sort of trade back down to the 18 sort of percent, or the 18 multiple in the stock market, and you get from where we are now at sort of a 23 times, that's a negative 24% return in the market. So there's not, again, a whole lot of upside to be had unless you, again, believe that we're going to continue to expand multiples, or we're going to get earnings growing back into this sort of mid-teens to justify the multiples where the market's trading at. It seems to be skewed much more to the downside than sort of what the market would sort of suggest where it's going. And then we get the question a lot of well, what about outside the U.S.? Most of those charts, again, were sort of anchored on the U.S. and the S&P 500. But where are we sort of in terms of across the world? And while they're cheaper relative to the U.S., they're not cheap relative to their history in almost every market. And so you can see Japan, and this again is a little bit dated. If we bring this up to sort of where we were at the end of the month, Japan has crept up significantly. Places like Korea crept up significantly. And so you're sort of getting in this rare air territory across the world. And so we're finding opportunities, again, around areas where we're not paying too much. But again, the U.S. has a very deep utilities market, very deep areas to find what we would sort of say are more defensive companies and opportunities there where we can get that double-digit sort of rate of return. And then I think I have one more here. Yeah, I think I have one more here. So this just kind of helps us understand where we are in terms of spending and sort of cap IT spending as a percent of GDP. It's again back towards where we were in the late 90s. And if you remember and you recall, I was old enough to be in this business back in the late 90s. And you remember there was a significant problem with Y2K, right? We heard that in terms of companies spending tons of money because the world was going to end. All the banks and all these companies were using software that only took a 2-digit date. And when the clock rolled over on December 31st of 1999, it was going to be the end of the world. And that was the belief back then. So they were spending a lot of money to correct that problem. And then again, the growth in the data centers. And if you look back, that tends to be a sort of thematic over time where you get this scenario where there's a lot of excess spending. We saw this in we saw this in IT spending in the late 90s. We saw this in the shale boom. And we saw this even going back to sort of name your favorite bubble over time, where you get a lot of excess capacity. That's very typical in the semiconductor industry. And these are being priced as their secular growth stories when the industry is and has historically been a very cyclical industry. And most of this sort of part of the semiconductors, if you look at memory pricing outside of the high bandwidth memory, which is sort of the AI, the AI part of it, it's not that great. We're seeing inventories rise, pricing for sort of standard memory products are rolling over, and the wafer processing industry is not doing all that great. And so if you take out, this AI spending, which is where most of it is coming from, it's not great out there. And this AI bubble is sort of masking a lot of weakness across economic sectors. We talk to companies like natural gas distributors, or industrial gas distributors that are, that's a feedstock for a lot of the economy, and they're not doing that great. Their numbers are not great, and there's a lot of concern sort of building up behind this. And even if you look at sort of IT capex as a percent of the weight in the S&P 500, because IT is obviously a more significant weight, it's still back to very frothy territories. And so again, this is just painting a picture to us where we have started to take chips off the table. That's been sort of a very early call. And it has led to sort of relative underperformance, but we think on a go-forward basis, if we do start to see some of this, and we are now starting to see this, I would say, over the last couple of weeks, where there's a lot of questions, there's a lot more articles being written about how are we going to get a return from this. I mean, initially, you've seen companies that are involved in digital advertising that were being, their profits were being boosted, their revenue is being boosted because of AI actually gave them a better product. It could target advertising better. It could sort out things. It gave them, similar characteristics to what the old sort of, Apple, ID could give them. However, now, digital advertising is 70, 80, more than that as a percentage of overall advertising. So it used to be a penetration story where advertising, was growing as a percentage of overall advertising. However, that's not the case anymore. So if it slows, they're going to feel the pain much worse. And advertising is a cyclical industry. And so if we go into a more of a slower economic growth, in fact, the World Bank GDP estimate for this year is the slowest it's been in 60 years, I think, 50 years. And so there's a very good probability that things slow from here and that returns are lower. I think it was a good question that somebody asked earlier. If sort of people had talked about, years back that, returns are going to be lower because the market did so well. I think it's not a big leap of faith to say if we drift back to, say, I think the long-term average, 50-year average for the S&P 500 is 11.5%. And we've been over that for the last several years, 13, 14% range. If we drift back to over the next 3 to 5 years to that 11.5%, that translates to a roughly 6-7% rate of return, compounded rate of return for the next 3 to 5 years. And so that's a very likely scenario where we get sort of a middle single-digit rate of return over the next 3 to 5 years if we drift back to the long-term average for the S&P 500. So I've said a lot. Maybe I will take a pause there and just take questions. I know we want to sort of behind time, so maybe we can catch up a little bit if there's maybe any questions out there from folks.
Kevin, thank you very much. Maybe just one very quick question from the audience. GQG has been overweight India in EM and global portfolios, despite being one of the most expensive EM markets, and now in the crosshairs of tariffs. Are you biased to India, or what's your views on India at the moment?
Yes, no, it's a good question. We still are very much, we still much very like India. And it really goes back to earnings growth. Really, there's not many places in the world you can get double-digit earnings growth these days, given all of the things on a long-term basis. And so India is one place where The government is sort of proactive in terms of privatizing industries and allowing, companies to grow and that earnings rates relative to a place like China, where there's constant crackdowns. There's a negative view towards companies being very successful in earning, and the private sector is very much an important part of the growth phase of India. They're pulling back on some of their government spending because they want private enterprise to do it. And so we can get the growth. Yes, the market is expensive, but you do have to pay for it. And so areas like infrastructure, areas like some of the banks, if you look at, banking in terms of, places like Korea or China, where they've been sort of regulated to the point where their return on assets are sort of, 0.5 to 1%, and they have, sort of low single digit, net interest margins. That's not attractive to us, but India, again, they have very sort of favorable sort of regulations, and just the mindset there is very different towards private companies, allowing them to earn. And so that's an area we like. Obviously, the economy and things. And with respect to tariffs, it's not going to be a big deal in terms of their economy. They obviously want to have good relations with the U.S., and everybody does, right? And so everybody's sort of kowtowing to what Trump wants to do, and they're gonna, I don't know. I think every time I hear about a tariff deal, again, there's nothing signed in ink on any of these tariff deals, so they can always change. And after the fact, when we've heard about it, they've said, well, we thought it was this way, and you said it was this way. And so it just seems like it's a bit more of a mess. But at the end of the day, if we get back to sort of, call it 15%, if that's the blanket rate across, that's not good for the economy in any shape or form. We went from 145, which is a ludicrous level, down to a level which is just really, really bad for the global economy. I don't understand why the stock market reacts favorably to that, because if you think about it, that has to come from somewhere. Either one, it's going, consumers are going to pay for it, and that's inflationary, or two, companies are going to have to eat it, and that's negative to margins. So there's no good outcome from any of that in our view, even if they land at somewhere around a 15% range. But with respect to India, I'll get back to your question. That is, that shouldn't impact their economy. They don't have a huge trade surplus with the U.S., and so they really, it's more about sort of the relationship, and then the last piece of it is, I think, the clients who know us best and use us, we do have some exposure to some of the Adani companies. There has been an issue where they're trying to get through this. There was a investigation by the Justice Department. It's had a bit of an overhang on the stock. I think that might be, in my view, I don't know this, but it could be part of the whole negotiation of getting this wrapped up, i.e. they really want to, improve their relations or keep a good relationship with the U.S., but they're not going to be pushed around. I think Trump seems to use those tariffs to get his way globally. And I think they don't want to, be seen to sort of just be, doing what Trump wants to do. However, they do want to keep the favorable. I think they're both transactional leaders, and they'll probably come to some agreement in time.
And Sheikh, somewhere, so let's see where it ends. Kevin, thank you so very much for your time this morning. Always great to have you. We're continuing with global multi-asset, and for our next session, we are joined by Alex Funk from Portfolio Metrics. Good morning, Alex. How are you?
Very good, Eugene. Thanks for having me.
Thank you for joining us. And for our audience, Portfolio Metrics is renowned for building solutions that actually plots almost to perfection on an efficient frontier, focused on portfolio construction and not storytelling. Alex, thank you so much for joining us. Looking forward to your presentation. You can share if you're ready.
Fantastic. So thanks everyone for the time. And I thought it'd be quite an apt time to start talking a little bit about portfolio construction, given all the volatility that we've seen in markets. And I think we really want to refer to this point. We can't really predict what happens in markets, but we can ultimately prepare for what that portfolio construction ultimately looks like. So as a starter, if we start thinking about asset allocation as the key driver, really, of risk and return, and again, that's the variation of risk and return rather than the ultimate outcome of it. The most important aspect really is going to be that strategic asset allocation component, right? We know that security selection and tactical asset allocation explains some of the risk and return drivers, but the most important is getting that foundation correct. I suppose the question we have here at this point, though, is how many different ways can you ultimately asset allocate, right? And there's definitely more than one way. And so I want to take you through two variants of how we can think about asset allocation and maybe some of the shortcomings when we think about long-term expected returns within this framework. So if we broadly compartmentalize asset allocation in sort of two broad camps, you can have an asset allocation model that thinks more around return expectations. You can have another asset allocation model that actually considers the risk elements of those asset classes slightly more. It still requires return elements, but it concentrates more on the risk contribution rather than the return contribution. And I'm going to use an example of a global multi-asset portfolio, and we're going to look at two variants. We're going to look at an optimization model that takes more of the return expectations into account. We're going to look at another from the risk perspective. So let's look at returns, right? So this is it clearly happened in the past already, but at that point in time, the returns between 1999 and 2014, there was really strong emerging market returns. Developed markets actually underperformed quite significantly. So if you were optimizing your portfolio, December 2014, you would sort of been a little bit potentially biased around what that emerging market return looked like. But then obviously, the return that followed post that was invariably the opposite of what ultimately happened. And so if you think about your balance for your moderate risk portfolio, you would have probably been a little bit overexposed to emerging market equity, not because you had done anything incorrectly, but because your optimization model took into account expected returns potentially more than it did the risk contribution of that. So what does that mean? So if we had a return-based optimization, we had some of that recency bias in the portfolio from an emerging markets perspective, versus a risk-based approach. So again, we know emerging market equities are volatile, so the way they generate returns is slightly different to developed markets because we've got FX and currency effects. But if we then start thinking from a risk-based approach, potentially it was slightly more pragmatic in that allocation. And again, the return differences are quite significant, right, over different snapshots and periods of time. And if we think about that in a portfolio context, again, using exactly the same example, what you can see is that if the return optimization portfolio relative to the risk optimized portfolio at that point in time in 2014, those returns are quite stark, right? Up to 63% compounded over the decade and beyond that really followed. So when we start thinking about asset allocation, we need to think about the things that we ultimately can control and the things that we can model more predictably. Expected returns is quite difficult. And again, this year is such a good example where, at the beginning of the year, we were calling the death of US equities as sort of post-Liberation Day stagflationary risks and the impacts of tariffs was going to be great. And right now, the S&P is again at all-time high. And so you can see how that narrative shifts around quite a lot. So forecasting is very difficult, but understanding the risk contribution of various asset classes to the portfolio is potentially slightly more consistent. And then it brings me on to the next part. So if we've got that foundation correct and we understand that strategic asset allocation, what do you do with it? How do you populate that? What are the things you ultimately want from the fund managers you invest with or the security selection that you're ultimately taking? And there is this sort of idea that you can definitely screw up a good asset allocation with poor implementation. Right? So what do we think about when we want to buy a fund manager? What is the exposure that you ultimately want? And I think as a starter for 10, tactical asset allocation is possible, right? And it can generate excess returns. It's difficult to do it consistently, right? And thematic views is a good example of that. So I often refer to this chart from JP Morgan, where this sort of analysis around themes were done, right? So ultimately, under Trump 1.0, would you have expected that clean energy significantly outperforms traditional energy? No. It was counterintuitive to his policies. It wasn't aligned to his agenda. But the reality is he couldn't account for, that sort of shift in 2020, and everyone wanted to invest in clean energy and so on. And vice versa, when Biden took over, it was quite the opposite. It was very much a clean agenda. It was very much around renewables. It was the Inflation Reduction Act. But what Biden couldn't account for was that Russia would invade Ukraine, right? And then we would have the energy crisis that followed. And so again, that underperformance. So I suppose from Mark Twain, it makes quite a lot of sense. It ain't what you don't know that gets you in trouble. It's what you know for sure, just that ain't so, right? And so when we think about that tactical asset allocation, we really need to think of where we can add that value. So what are the risks you want in your portfolio? What are the risks that are worth paying for? And so this is an interesting study that was done by the Active Share and Mutual Fund Performance in the Financial Analyst Journal. And it sort of blocks up performance in different categories, right? So you have high tracking error, so big deviations from the benchmark, low active share. So again, not very different in terms of security selection. Then you've got low tracking error, low active share, which is very much index-like. And then on the top, you've got high active share, very different stock selection to that of the benchmark. And then you can have a variation of that. So like high tracking error, very big differences in terms of sector and distribution allocation. You can have really low tracking error, so a little bit more tight in terms of what that benchmark looks like, but still talking about that security selection. So what is interesting is that high tracking error, low active share, these sort of factor portfolios that you can build yielded the worst results on a relative basis, right? As we moved into closet indexing, we know that this doesn't yield positive results. Why? Naturally, it's the fee erosion that happens over time, and you're just compounding that tracking error consistency and or lack of consistency rather due to fees. On the other side, concentrated stock picks, so having a handful of positions that have a high tracking error, so very different to the benchmark. So again, paying for that active management, which is great, but then also having the high active share. The combination of that works at times, but doesn't work consistently. And I think that sort of lumpy return profile can result in underperformance as well on a relative basis. Interestingly enough, the position that did the best was that had low tracking error, so cognizant of the benchmark, cognizant of that sector distribution, but had a very high active share. Right? Thought about the securities they selected, made sure that they were independent of each other and they were not correlated. So where we like to focus is in this high active share, low tracking error position when it comes to populating that strategic asset allocation, which again, as I mentioned before, is very much on a risk orientation. So what is it that you're looking for in a manager then ultimately? We want many independent, uncorrelated positions, but scaled appropriately and actually taking those risks deliberately, right? And so if we think about the independence, we sort of talk about this idea of a portfolio of ideas versus a single portfolio idea. What does that mean? It means you could have 8 positions in a portfolio, but if they're all linked to the movements in the oil price, that's not a portfolio of ideas. Your portfolio is highly referenced to one macro event, which is largely unpredictable, right? But if I have 8 positions that are affected by multiples of reasons and outcomes in the world and the real economy, now we've got diversification. So independent security positions, and I think we often get stuck with this idea between perceived diversification and actual diversification. The second bit is scaling those positions appropriately. I think, Woodford is a great example around conviction-based positioning in ideas versus probability-based positioning in ideas. And having high conviction is important, but also scaling those positions based on the probability of what those outcomes look like is quite important. So when we're talking to an active manager, we want to make sure that they understand the probability of loss, the upside, the margin of safety within those positions. And then lastly, deliberate investments, right? Making decisions and taking risks deliberately rather than inadvertent risks. And this is where tracking error can catch you, right? Because as we saw with that thematic investment chart that I showed, just taking a complete bet off of energy leaves you exposed. And that might just be because of your investment process, not because you had an investment thesis because of that, right? So taking those risks deliberately, intentional risk taking, and not being caught off guard just because your process has actually left you vulnerable in terms of the diversification benefit of the portfolio. So what does it look like? So if you look through, and what I'm showing up here is a risk attribution. So this is a typical star analytics chart for those of you that are close to this. And when you look at a fund, what you ultimately want is a lot of the risk contribution, a lot of that active risk to come from the asset class itself. So in this case, it's equity. So we want a fund manager really to have really high risk contribution in the equity component. We don't want those style aspects. We don't want those large sector bets because these things are largely unpredictable. And the variation between style tilts is quite difficult to get right consistently. If someone asks me if value or growth will outperform this year, it's very difficult to get that right consistently. But I know that if I have consistent exposure to the equity risk, that will be rewarded based on my asset allocation model. So again, these two things are talking to one another. So we can see really high risk exposure to the equity component, very little to all the other aspects. And you can see that with a fairly low tracking error when it comes to the portfolio as well. So I think what you really want to focus on when it comes to portfolio construction is obviously not counter A and is counter B. So a lot of people are very interested in stories and ideas around stock selection and why Rheinmetall might do well because of European defense spending. But what we need to focus far more is around that portfolio construction. How does it position? What does your tracking error look like? Do you have inadvertent risk exposures in the portfolio? And how has it been sized? Is it probability-based sizing or is it conviction-net sizing? And ultimately, when you look at that portfolio, can you confidently say you have a portfolio of ideas rather than a single portfolio idea? So to bring that to life a little bit, I suppose you can really undo fantastic asset allocation with bad implementation, right? So bad selection of the securities which you want within that portfolio as well. So here's a good example as to one of the big ideas that we didn't buy. And I think the timing is quite apt from this perspective as well, because at the beginning of the year, if I had £1 for every time someone walked into my office and said, Alex, now's the time for S&P 500 equal weight, I could probably have retired by this point in time already. And the story goes quite simplistically, like really long-term, consistent outperformance of the S&P 500. You're diversifying from Mag 7, it's overvalued. You can't have these positions in your portfolio. There's no diversification. And it looks compelling, right? It looks compelling on a chart. It looks compelling from a narrative perspective. It reduces that concentration in your top 10 holdings. But when you really start to think about it, you need to analyze what are the risks you're taking. And if you think about that style box of where managers or where positions actually do well, these sort of factor bets might not be the place. So what are the risks? So what I've got here for you is the S&P 500. So as it is, with their Mag 7 concentration, and then I've got the S&P 500 equal weight, which effectively takes 0.2% in every position. Look at the relative positions you're taking, right? These are quite significant in most instances, both in the underweight and the overweight component. So what you're effectively saying is that you have more information than what the market is priced based on these positions, and you're taking an active position on that. There is absolutely nothing passive about an equal weighted index, right? This is absolutely an active decision and those relative positions that you're taking. Another thing you might inadvertently be doing, again, we're talking about intentional risks versus inadvertent risks. You might just intentionally be overexposing yourself to a factor bias, right? And so what you can clearly see here is you've got an overweight to the value factor, right, which seems a bit counterintuitive when you're bought an equal weighted S&P 500 index on face value. You've got an overweight to mids and small companies, so you're taking a size bias and you're taking a value bias. These have to be intentional decisions when you take them. So when you're buying something to diversify potentially from one risk, be careful that you haven't undone the Rubik's cubes on another side of your portfolio construction. And this is fascinating as well. So if you look at an active stock position within the financial sector, which was one of the larger deviations, what we can ultimately see is we are underweighting the large national banks and taking a position in small regional banks. So again, maybe these are deliberate decisions that you're making from a tactical asset allocation perspective, but you need to understand the risks. You need to understand the contribution to what that brings to your portfolio. So did you actually want a value bias, a small cap bias, and an overweight to small regional banks within your portfolio construction? And if you extrapolate that out, like what could go wrong, right? So understanding that probability-based sizing within a position like this is quite important. So if we look at the volatility and we look at the tracking error of this portfolio, there's a variety of possible outcomes that could happen based on the distribution, right? So yeah, you could have a really strong year. You could outperform the S&P 500 by up to 11%. But on the same side, you can downside this. Again, this is sort of more normal distribution in aspects, but the reality of those differences are quite large. Right? So again, you got to sit down and say, well, what is the information you have that the market has not priced in order for you to take those positions from a sector distribution, so upping that tracking error relative to the S&P 500. So I suppose if you had to summarize from an investment thesis perspective, there are probably some large known and very quantifiable risks. And again, if taken intentionally, absolutely fine. But I don't think that was what the S&P 500 equal weighted has been for most this year. A value bias, a small cap bias. You're preferring, sort of regional national banks, think SVB, over large national banks, and you're taking a position on financials relative to technology, right? So these are maybe advertent or inadvertent risks within your portfolio construction. But one thing is absolutely for sure is that the return profile on a relative basis is very inconsistent. And so this is a slightly busy chart, but I'll walk you through it. What it shows is the excess return of the equal-weighted S&P 500 on a 1 year, 1 month rolling basis, right? So it shows you some of those variations that you can have within return at different points in time. Again, most of your clients didn't invest at the launch of the S&P 500 equal weight is not going to hold that for the next 2 or 3 decades, right? So we have to consider different entry points of investors, hence this rolling period of returns. And what's interesting is the equal weighted S&P actually doesn't provide the protection in periods of crises when you actually need it. Right? Again, so like the COVID shock, we saw that in the 2020 bear market, it didn't help. There was a small period of reprieve where it did well within a few months around Liberation Day, but ultimately didn't continue. And then you'll see those little green lines and those little red lines, and that's effectively when the spread, like the difference between the equal weighted and the S&P 500 is greater than 2%. So you can see it's quite limited. So those extreme periods of outperformance or underperformance are quite limited. But that return journey isn't something I think that most clients want from their portfolio as well. They want more consistency in that return journey, specifically for such a large portion of global markets as well. So to summarize, I think when we start thinking about portfolio construction in a world that has lots of volatility, we got to think about it in 3 aspects. We need to understand the risks. We need to limit our reliance on forecasting because, again, it's quite difficult to do. You may get it right sometimes, but you're not going to get it right consistently. Take the risks you want, right? So understand and on a look-through basis exactly the risks that is coming to your portfolio and take them quite intentionally. And then lastly, avoid the storytelling. Focus on the risks that's coming to your portfolio. Focus on idiosyncratic risk, asset class specific risk, because that you can ultimately diversify away. The systematic risk, the interest rate movements, the deficits, the movements in politics, the prediction on where inflation lands, these thematic plays are very difficult to diversify away, and that's called the systematic risk in your portfolio. So hopefully that gives you some food for thought in this current market period of where things are moving around quite a lot. But I'm sure we have a few minutes for questions if anyone wants to delve into that a bit deeper.
Alex, thank you so much for that. Very interesting indeed. And you made me rethink some of my thinking. So thank you for that, and fantastic work that you do at PMX. I'm sure there's a couple of audience members that are going to re-watch your session a couple of times. Very quick question with regards to global equity allocation in client portfolios. And I've spoken to some intermediaries over the past 2 years, and they're almost at the point to say, but I give up in selecting active managers. I'm just going to buy ETF, MSCI All Country or MSCI World. Your thinking around allocating to global equity, active versus passive, do you combine this? Because I mean, you mentioned that your asset allocation could be right, but it's all about the implementation, how you do it. How do you guys do it?
Yeah, it's a fantastic question, and if I can invite it back, I've got about a 30-minute presentation on what I call actively investing in passive, right? So there is almost no such thing as passive investing. Every decision to buy passive is an active one. But passive is a reasonable starting point, right? Markets are fairly efficient, information prices quite quickly, but that deviates across different parts of the world, right? So we spend a lot of time unpicking the inefficiency premia within asset classes, but across asset classes, right? So what is the hit rate? What is the historical hit rate of active management within different asset classes and across different asset classes? So if I pick on the UK as a good example, the FTSE All Share, is broken up into sort of large, mid, and small cap companies. In the large cap space, markets are quite efficient, right? It's priced quite well. People generally, struggle to consistently outperform the FTSE 100. But as we move down into the mid cap and the small cap, that active management outperformance track record shoots up significantly, right? Why? Because the inefficiency premium is greater. There's less allocation, there's less analysts. Therefore, it allows great active managers to absolutely exploit that. While if I take the S&P 500, the chances are slightly lower, right? Again, it's a large market, it's well covered. The information about Apple, Nvidia, and all of that is regularly priced. And active managers struggle because of the concentration of those positions, right? But if I go into the smalls and mids, again, it's a fantastic place for active management. So I think the active v passive argument doesn't exist anymore. It's active and passive, and that's not linear either, right? So you might have an overweight passive in the US, but an overweight active in EM. And so you have to think about that portfolio construction quite granularly and potentially on a pure global basis. You can't just cut the divide between active and passive.
Been very insightful, Alex. Thank you so much for joining us this morning, and thank you for your time.
Awesome. Great to be here. Thanks, everyone.
Right, we are moving on. We are sticking to global equity. And a long-time favorite and a frequent flyer of most of our webinars and roadshows. It's my absolute pleasure to welcome back, all the way from Jersey, Gary Hill from Martello Asset Management. Good morning, Gary. How are you?
Good morning. Yes, I'm great. Thank you, Eugene. Thanks for having us back, and we're looking forward to talking about our fund once more and some of the sort of interesting macro environment we're in at the present. I'm also joined by my colleague Shane Dillahay today, who works with me in the office here in Jersey. So there'll be two of us on the call this time, and the idea really is to run through the current setup of the portfolio and to maybe introduce some of the new stocks we've been adding to it over the recent months as well.
Gary and Shane, thank you so much. Gary, if I just want to check, you're going to share your slides from your side, so you're welcome to pop them up if you're ready.
There we go.
Fantastic.
All visible?
Thanks, Gary.
Thank you.
Yeah,
all good.
Okay, we'll start here, Eugene. I think one thing that I just want to clarify as well is that Martello Asset Management, the investment advisor to the Global Equity Fund, we were acquired at the end of last year by a company in the Isle of Man, Capital International Group. So Martello is now a fully owned part of Capital International, who I think are known in South Africa for their investment platform, and they have a presence in Cape Town and in Johannesburg. But the fund itself remains as it is, so that the branding of the fund, and obviously the mancos behind it, and the branding of the fund in South Africa remain the same, and the investment philosophy and the approach and construction of the portfolio remains as per the slide here, which details the investment approach and just summarizes the construction methodology behind the fund as well. So no changes on that part. We remain the same as we've been for the last 5 years, very much a bottom-up approach, high conviction global equity portfolio, using our sort of proprietary screening process for stock selection, overlaid with macro information, and also the proprietary timing overlay we use for entry and exit decisions for the portfolio. So it's been quite an effective strategy for us, and we've seen some nice growth in the fund this year as well, supported by our new parents. So all good news on that front. This slide here is actually the full picture of the portfolio as it currently stands, and we'll spend some time just looking at this now and giving you the information on how we're positioned and what's been working for us this year and what hasn't, and where we see new opportunities for the portfolio going forward. So as you can see, there's a three-silo approach for the portfolio. Some core positions, which are circa 5 to 6% position size, the conviction stocks, which really forms the bulk of the portfolio, and our tactical positions as well, which are often stocks which are coming in or perhaps exiting the portfolio, new ideas or slightly higher beta, etc. So that remains the same. The number of holdings is currently 31. Currency split, which has been quite a big driver to returns this year. We have about a 54% exposure to the US dollar, US equities, 33% or so in Europe, including obviously Switzerland, UK, and Scandinavian countries. And then the balance is in cash, where we're about 5% at present, and some ETFs for Japanese and emerging market exposure. The active share in the portfolio is around about 82% at the moment. And the active weight to the benchmark, certainly in the convictions stocks, gives us what we believe is our sort of opportunity for alpha generation, which is at the heart of what we do. So performance year to date, the fund is up about 17.5%, so we're about 4% ahead of the global benchmark. The attribution effect for that, 2/3 of that has come from stock selection this year. Some great contributions from certain stocks, which we'll talk about. About a third, the other third has really come from asset allocation. But in terms of contribution as well, currency has played a big part this year, given the sort of significant weakness we've seen in the US dollar and the the opposing sort of strength of other currencies. So that's been a great contributor to return this year, but it's something which we kind of anticipated really at the end of last year, given the very high level of US asset prices and the dollar entering 2025. So in terms of contributors, we've had great performance from Rolls-Royce this year. Monolithic Power, Vinci, Netflix, NVIDIA. NVIDIA is a stock which we added to the portfolio in April. We thought there was a great opportunity to buy it with the sell-off associated with the tariff announcement. So we added it to the core part of the portfolio, and it's been we got in there at $87, and it's doubled in size since then. So yeah, great contribution from NVIDIA. Otherwise, activity really has been around kind of making sure that we have enough diversification in the portfolio, the balance between sort of higher valued growth stocks, some of the more interesting aspects of the European market, individual opportunities there, and some new ideas which Shane will talk about in a second. Detractors really have been, in areas very stock specific. We've had Novo Nordisk obviously having a pretty terrible last 12 months. Kitchen sinked a lot of their sort of growth guidance for the US market for the second half of this year. It's clearly been on a hit list for a lot of investors, a lot of short interest in the company, but we feel that with a lot of that news now in the price and a clear sort of change of strategy to tackle what was becoming a little bit of an issue for them in the US, we feel that this is a good entry point, and we've been building our position back up in Novo over the last few weeks. And then I think other than that, it's been perhaps stocks which have had good earnings, but have guided a little bit more, cautiously for the second half of the year, mainly on concerns about the impact of tariffs on delayed order times, etc., for large capital items, something like ASML, etc. So great set of results, very happy with the earnings, but obviously quite cautious on guidance for the second half of the year. So that's really been sort of the theme that we've seen since the start of the second quarter earnings season. But as I mentioned, so cash is sitting at around 5% at the moment. We're looking at a couple of new ideas for the portfolio, but I'll just hand over to Shane now just to talk about some of the stocks that have sort of interested us and we've added to the portfolio over the last couple of months.
Perfect. Thanks, Gary. So as we're discussing the fund, we thought it'd be a good idea to go over some of the more recent additions, just to give a flavor of the types of companies we invest in and the process behind them. So both KLA and GTT are more of the recent additions to the fund, both being added in the last year or so. So KLA is a global leader in the process control and yield management space within the semiconductor manufacturing sector. They produce the tools and the software used to measure various parts of the manufacturing process as well as packaging, to ensure that the companies that are making the semiconductors do so, get the best yields, make the most semiconductors, and produce the least amount of defects whilst running them. Their largest customers include global foundries, as well as logic and memory manufacturers, so companies like TSMC, Samsung, and Intel. KLA is very similar to ASML in the sense that there are very few companies that make similar products on offer within the space, and that's purely because the amount of R&D that is required to produce the machines, the long lead times just to get us to this stage. There are very few alternatives in the market. So ASML makes the machines that makes the semiconductors, and KLA inspects the process line and ensures that everything is running as smoothly and as efficiently as possible. So KLA offers good exposure to the semiconductor equipment sector without having to pay such a premium. So if you were to buy KLA today, you would be doing so paying a roughly 26 times forward earnings versus a sector average of around 45 times. And as well as getting a cheaper stock, you're also getting one with high revenue growth, high earnings growth, as well as higher free cash flow growth over the last 5 and 10 year periods. In terms of growth trajectory and growth areas for the fund, as well as the stock, sorry. Particularly 5G and AI has been significant tailwind for KLA and the wider semiconductor industry over the last 3 to 5 years. So both of these technologies require more advanced semiconductors, as well as thinner process nodes, which is obviously a big outlay for the foundries that produce these products. So KLA is very deeply ingrained with these clients. They work with them from the initiation of the process to ensure that they can effectively monitor and process from start to finish, which makes the clients particularly sticky to KLA and expensive to switch clients, and it could also risk lower yields as well. There are some trade restrictions in place on KLA as well as many other in the semiconductor industry, been in place placed by the US towards the end of 2022 for exports of their more advanced tools and equipment into China. China revenue has normalized now, so it was around 43% in 2024. It's now normalized to about around 30%. But you are seeing the US government do deals with companies like NVIDIA and AMD to allow them to sell pre-approved devices into the region. So if this is more widely adopted to more companies, this could be a tailwind for companies like KLA. On the flip side of this, you're also seeing a number of semiconductor companies reshoring back to the US. So again, this could be a significant tailwind for KLA as more money is being spent on US production. GTT, so this is one of the fund's most recent additions. They design and license cryogenic membrane containment systems that are used in the transport and storage of liquid natural gas. They're used in refurbishing existing older vessels as well. This is typically done on a licensing agreement over either a 5 or 10 year period, which makes the revenue quite consistent and reoccurring. And this equates to around 3 to 4% of the ship's total build cost. So this membrane technology is used to ensure that the liquid natural gas stays liquid under consistent pressure and at a temperature that is negative 163 degrees Celsius. So as you probably guessed by the description of the product, there aren't too many companies that do make alternative products, which is good for GTT, who maintain a nearly 90% market share of the LNG carrier tank design market. Growth drivers are there are several that directly and indirectly impact GTT. So the global shipping is a key one. So as countries and companies work towards lowering their carbon output and their greenhouse gas emissions, shipping is one of the key contributors. So many are incentivized to reduce that reliance on global shipping and the output of the higher carbon fossil fuels. So LNG powered ships, they're not new. They've been around for a number of years, but they have really gained traction in the last decade or so. So in 2010, there were just 21 LNG fueled vessels in operation. Today, there are over 590, with another 565 on order, with the majority of them being expected to become operational by 2028. So again, significant tailwinds within the wider LNG market, which should benefit GTT. In general, the LNG market has grown well over the last decade, growing at around 6% per year, making it one of the fastest growing segments within the energy industry. So as companies and countries move towards cleaner alternatives, LNG stacks up versus versus other fossil fuels like oil and in particular coal, which is why they're seeing a significant uptick in China demand as China tries to reduce its reliance on heavier carbon fossil fuels. And then of course,
Shane.
Thank
Sorry,
you.
I was going to mention maybe just worth mentioning the sort of the margins we're seeing here and the valuation you're paying for that.
Exactly. Yeah. So because it's such an asset-light business and a licensed business as well, you've got some of the highest margins in the energy sector. I think second only to Saudi Aramco, and you're getting all this for a company that's trading currently on a forward P of 14 times.
Thank you very much. Cheers. Thanks, Shane. Dan, I forgot to mention, actually, we had an investment poll as well that we were going to ask the audience just to look at. Is it possible to bring that up just before we talk about maybe some of the macro side of things. Maybe I've left it a bit late. Okay, maybe we'll talk about that perhaps after the macro side. So yeah, just to wrap up, I thought we'd just cover some of the sort of more pertinent sort of macro information we're seeing at the present. Clearly, this has been a pretty eventful year from the perspective of global trade and tariffs, the impact of which we don't believe we've really seen yet in terms of who pays for these. I know there's been a recent sort of bit of analysis which suggests that so far 64% of tariffs have been absorbed by companies in the US, but this is likely to fall to perhaps single digits by the end of the year, and the transfer will go back towards the consumer. So clearly there's been a massive shift in terms of what this means for global trade. The level of tariffs going to a level which haven't been seen for many decades, and the impact is going to be significant. So far, we've seen some data suggesting that the jobs market in the US is showing signs of slowing down in terms of job openings, etc. And clearly the case is trying to be made by supporters of the Trump presidency in terms of pushing for a rate cut on the back of that. I mean, I think some of the data is actually still quite contradictory. We're seeing very high levels of the reservation wage, i.e. the rate at which workers will make a decision about shifting jobs. That's gone to a post-COVID high. And the jobs market is also churning quite heavily at the moment as well, with quite high levels of turnover, again, reaching sort of post-COVID highs. So the evidence really isn't there to justify a rate cut based purely on the unemployment data. And when you shift also to the inflation data as well, there's grounds to be sort of skeptical that we're seeing above target inflation. We're also uncertain at the moment as to what the impact of tariffs are going to be on certain areas of core goods pricing, etc., in the US going forward as well. So put the two together, and although the odds are on a pretty high level for a rate cut in September, just purely on sort of fundamental grounds, they don't really look justified. So clearly, without the politically driven sort of pressure to do so, there's take that away, and you would really say that the US economy is actually in a pretty good shape at the moment, and a rate cut isn't justified. So that's got to be factored into thinking right now, and certainly in terms of what we've seen as the market's rallied from its low point in April, and the sort of euphoria that's developed around certain sectors again. So that really explains perhaps why the sort of the US 10-year yield is really trading at a level it's been at now for almost 3 years, in quite a tight band. This isn't really representative of a treasury yield which is sort of anticipating a rate easing cycle happening. So that's pretty sticky, and there's obviously other drivers that are causing perhaps sort of skepticism about where yield should be in the US right now. One of which obviously is the massive supply of treasuries coming onto the market as well. But on a more positive note, we've had a very strong quarterly earnings season, not just for US companies, but also for many of our European ones as well. And outside of that into emerging markets. I think the S&P year-on-year increase was something like 11% on earnings, of which I think the Mag 7 was 26% year-on-year as well. So a strong quarter, definitely. Quite a lot above expectation. I think it was being sort of certainly fueled by a weaker dollar, supporting the translation effect into dollar earnings. But like I said before, we've yet to see the impact of tariffs on corporate earnings going forward as well. So that's something to be wary of second half of the year. And also this as well, you can't get away from the fact that obviously valuations in the US are at extremes again, and we're seeing the S&P now trading at its sort of highest multiple to sales in its history as well. So just to sort of wrap up, our approach really has been to be diversified across sectors and across geographies this year, benefiting from the tailwind of a weaker dollar and the contribution from currency in our portfolio. And we see that continuing, really. We don't see any reason to change that at present. And we're just staying sort of cautious at the moment in terms of US valuations and the amount of optimism that's sort of been baked into prices at this level. That's really it from me, Eugene. Sorry about not bringing the poll up earlier. I don't know if there's time to do it now or if we've run out of time.
No, we can do it quickly. I mean, let's do it. It's always interesting.
Mm. It's certainly interesting from my point of view to hear what people think.
Changing very quickly. Yeah.
Okay.
And EM again, I would think that EM would include SA from an SA investor perspective because there's no
Absolutely.
SA box. Yes. Although SA and other EMs very different.
Yeah. No, I'd agree with that. We do have an exposure in the fund now to sort of high yielding areas of EM, which include some of the commodity, energy, banking, insurance plays, etc., which actually has been quite a nice contributor towards return this year as well. And I think the currency aspect is also key there.
Japan is fascinating because I mean we all know the yen is the cheapest currency and you can maybe make some good money out of the yen. But what about Japan? I mean, overall Japan run fairly hard. Is that a place to be?
Yeah, no, we've had an exposure there for the last 6 months or so. It was quite new to us in terms of adding that. It's certainly contributed. I think the macro environment there has been obviously improving. The effect I don't think really has been seen on the yen just yet. Oh, that's interesting. So yeah, EM 46. Okay.
Gary, very quick question on currency, the call where currency is going to end in 6 or 12 months. Of course, I mean, who knows? But what do you make of the dollar, and how do you position for that in client portfolios? Because I mean, and you did mention that weakening dollar did add some value to your fund. But I mean, are we in a structural decline of dollar value? Not because it's the end of the dollar by no means. It's just been overpriced. And how do you position for that in a portfolio? Because I mean, if there's further decrease in dollar value, I mean, surely that can wipe a lot of your positive returns in dollars.
Yeah, I mean, we don't hedge currency, and certainly we've noticed over the years that it's been. I mean, the strength of the dollar has been a headwind to obviously non-dollar exposure for some time, and it's coming back into favor perhaps as a way of adding performance at the moment. But ultimately, our decisions are about the stocks themselves and whether they're priced in dollars or not. It's more to do with the companies. But I do think there has been a shift in terms of skepticism about obviously the independence of certain areas of the US in terms of obviously monetary policy. That's changing at the moment. The escalation of or the expansion of the budget deficit. And the impact and the effect that's going to have on bond yields going forward. So we've definitely seen quite a pronounced withdrawal of interest from some certain parts of the US sort of asset market, and I think that can continue, particularly with the presidency that we have and the sort of chaotic nature by which he's running the country at times. So it's a vote of no confidence to me at the moment about the US and. Yeah, I mean, I can see it continuing. So within the portfolio, we're benefiting from it. That's for sure. We don't have a specific target in mind in terms of what currency exposure we want outside of the dollar. But for the time being, we're very happy to be running what we have.
Always good to have you on board with a good perspective on what is sensible in a global portfolio. Gary and Shane, thank you so much for joining us this morning. It's always great to have you. And we'll keep in touch and chat as we trot along. Thank you so much.
Pleasure. Thank you.
Thanks, Eugene.
Right, on the ready to go for some time now, and I've kept him waiting. When you look at returns of the Randmore Fund, I mean, it answers that question on one of the polls that we had, value or growth. So you would shout out value. But then again, if you had a fund with phenomenal returns over the past 12 months, is this a time to buy, or do they take profits and look for new great opportunities? Joining us now, Andrew Lapping, Chief Investment Officer at Grandmore Asset Management. And you are in France this morning, Andrew. Thank you that we could bother you all the way in France. Thank you so much for joining us.
Eugene, thanks so much. And thanks for all the attendees for hanging on to the end. I hope everyone's still awake and eager to go. I'll try and make it interesting. I'm going to chat about two things. One is Asia, and the second one is the capital cycle. Asia being because we seem to be finding a lot of value there at the moment, and the capital cycle because it's something we do monitor, and we like to go where capital is not going, and we like to avoid, like the plague, places that capital is going. So let me get going. So a reminder what we do, and I'll speak about this in the context of our portfolio. We look for value. We don't care where other people are looking. We don't care where the hype is. We're just looking for undervalued companies. And as it happens, in the last couple of years, Asia has been a place where we find a lot of value. If you looked at our portfolio, I guess a year or so ago, you would have seen 20%, or not quite, 18% of the portfolio invested in Chinese stocks. It's now come off as the Chinese market has rallied, but still by far our biggest exposure happens to be in Asian companies. And that's not because we purposely kind of looked for Asian companies, not because we looked for Korean companies. It's just we run various screens looking for value, and they popped up. So we found companies that we think are trading at very attractive valuations. The other good thing about the crowd is the crowd is rushing towards the States, rushing towards tech, etc., and they've forgotten about Asia. And because the crowd is running the other way and leaving stuff on the floor for us, fantastic. Okay. The other very important thing is management must be on our side. That's one of the things we look at. How do we judge if management's on our side? We look for companies that have consistently made decent decisions. And we kind of are cautious about management whose only concern is their own pocketbook, basically trying to enrich themselves. And it's astounding when you look at mid-cap US, small-cap US, all they seem to be doing is trying to enrich themselves, whether that be a small company paying the CEO $15 million or huge dilution from share options. In Asia, you don't see that. Very often, particularly in China, almost all the stocks we owned were still owned by the founders. Zero options, zero share options. In actual fact, most of them are just buying back stock, very modest pay packages. And this puts them in a strong global position. Your costs are low because you're not paying the C-suite $100 million a year, which is great. The other nice thing about Asia is very strong balance sheets. These companies avoid debt. In many cases, they've got net cash in the balance sheets. That just gives you option value. When times get bad, you can then buy back stock, buy the competition, weather out the storm. This is the absolute opposite to many American companies. Yes, the big tech companies I know don't have net debts on the balance sheet, but the vast majority of normal US industrials are very highly geared. So something we also look for is consistent cash flow and dividends. Very strong in Asia. Why? Because often the way the founder's making money out of the business is taking dividends, and we share in that. Some of our great positions we've been exiting China, 30-40% owned by the company, so by the founder. The guy's earning $500,000 a year, but he's making $100 million a year in dividends. But we share in that. It's not taking it out of our pocket. So cash flow dividends, very important for us. Sorry, I'm just keep an eye on the time. We don't make macro forecasts. Why? Because macro, it's a waste of time. But what we do like is when the odds are on our side. Okay, and when I say the odds on our side, let's just look at, say, the US, because that's where everyone is, versus the average Asian business. Less hubris. I mean, it's just the kind of American exceptionalism and the belief it's going to continue forever is quite funny. I mean, to think that, the US thinks stopping China getting technology and using NVIDIA chips will stop them developing AI. It's kind of comical. You just look how Chinese automobiles have developed, how BYD has become the leading car company in the world. Why? They work harder, they pay the engineers less, and they're more motivated. So you contrast that. You look at lower wages, a highly motivated youth. Okay, these people are not all claiming disability for mental health issues. They're out there, they're working. There's room for growth. There's room for wage growth. There's room for more consumer spending. And they're willing to change things. You're not sitting with these holy cows that people are terrified of changing. The government is willing to make changes and drive growth. So what that means is total bottom up. 40% of our portfolio happens to be invested in Asian companies. You contrast that with, again, totally bottom up. Only about 20% of our portfolio is invested in North America, maybe in the small mid-cap space. We do have one or two large businesses in America, but these are companies that we think in the US are growing at reasonable valuations, just like the rest of our portfolio. And that Asian allocation has grown as we sold Europe. You remember a couple of years ago, one of our biggest exposure was European banks. European banks are done very nicely. And it's amazing how the mood changes. So SocGen used to be a top 10 position for us. And just last year, in August last year, I don't know if you remember, the French government was just having a little bit of a shakeout, and people worried about the French government collapsing. SocGen was trading at $20 a share, sorry, euros, 22 euros a share. Nothing's changed. The French government has not solved a single problem, but suddenly people have forgotten about that. SocGen, 50 euros a share. We owned the share back then. The value changed. Do we own it now? No. Okay. Now looking where we are in Asia. So various regions, you see Hong Kong/China, about 14% of portfolio. Some stocks in Indonesia, we're accumulating a few positions there. Bigger Japan, and then South Korea. So South Korea, we had zero exposure at the start of the year. We actually took this exposure a lot higher than this, and some subsequently sold. Why? As those European banks were running, achieving book value, things like that, we looked at Korea. The two biggest banks in Korea had what they call a value up policy. So how to extract value, close the price to book gap, increase dividends. We're trading at half book. KP and Shinwan, half book value. Even we bought more into the kind of Trump shakeout in March, April. They've both done very nicely, and we exited those positions. We now have some industrial companies in South Korea. We just started buying a consumer goods company. Fantastic track record. 25% of the company in net cash, owned by the founding family. 11 times earnings. I mean, what more could you ask for in this world of generally, we think, pretty overvalued companies? And just an example, I mean, we happen to own Haier. You may not have heard of the company, but it's the biggest maker of that and Medea, the two biggest makers of white goods in the world. So fridges, washing machines, that kind of thing. Whirlpool is the American equivalent. We don't own Whirlpool. And literally, these are the first ones. I didn't try and pick the best comp. I just thought we own Haier. What's a good comp? Okay, Whirlpool. So Haier is quite a lot bigger. It's got a market cap of 32 billion and an enterprise value of 29. What do you see by that? You see it's got $3 billion of net cash in the balance sheet. American company, market cap of 5, $7 billion of debt on the balance sheet. Total opposite. Haier, been spending 5% of revenue in R&D for the last long time. Whirlpool, been spending 2% of revenue in R&D. What does that mean? Haier's bringing out fantastic new products the whole time. Whirlpool, not so much, okay? You do like Tesla, BYD. BYD constantly innovating new cars. Tesla selling the same model it sold 10 years ago, okay? What does that mean? Well, Haier's growing revenue at 7% a year. Whirlpool's shrinking revenue at 4% a year, okay? Now you look at the valuation. A growing business, Haier, people are paying a lower valuation, a lower EV/EBITDA than Whirlpool, okay? But actually for us, what we look at is price to free cash flow or EV to free cash flow. So free cash flow, that's what's available to shareholders to buy back stock, pay dividends, put up cash in the balance sheet. Haier, 14 times free cash flow. Whirlpool, 31 times free cash flow, okay? PE, Whirlpool, because they're always write-offs, etc., not making not making any profit to the bottom income statement. Higher, 11 times earnings. High's actually issued some small stock in the last 5 years, so they've done share buybacks. What's Whirlpool been doing? All Whirlpool's been doing, like the vast majority of US companies, is trying to boost their share price using buybacks. Okay, so instead of spending money on R&D, they spend money on buying back stock, trying to boost the share price for the pocketbooks of the management and share options. Okay, so you're sitting net debt on the balance sheet, you're buying back stock. Craziness, totally unsustainable. Okay, 4 minutes left. The capital cycle, very important to us. We avoid areas attracting high capital flow. Why? Because capital flow brings down returns. That's all it does. Okay. Why? Because aggressive capital investments means lower returns, more competition. We don't want to be there. We prefer to go elsewhere. So actually, we invest where there's apathy, where people are, oh, we don't want to be there. That's where we find interest. Okay. Where there's lots of excitement, people all rushing, that's the kind of places we avoid. More capital, more competition, lower returns. That's not for us. Okay, that's for other people. And just an example of that capital cycle, obviously AI it's a huge thing. I mean, it's going to change the world for sure. It doesn't mean we know who's going to make the money out of it. And the market is pricing as though they know exactly who's going to make the money out of it. And also, you've got big tech investing vast sums of money. And when I say vast sums of money, this is just 3 big tech companies in the US investing $250 billion. Microsoft, their capital budget for this year is $120 billion a year, or this year. They're spending more per quarter in CapEx than they were spending annually 2 years ago. Okay. Are they likely to get fantastic returns on higher capital? It's just the odds are moving against you. They may, we don't know. That's not a risk we're willing to take. And the irony is this huge CapEx is now flowing through the value chain into the chip people, into the chip suppliers, into the people that do testing for the chips, that whole value chain. Earnings have gone crazy, valuations have gone crazy. Why? Because I think it's going to grow and carry on forever. Actually, it may not, and we're just not willing to take that risk. That's a risk we want to avoid. Why? Okay, sorry, let me touch, before I do the conclusion and do questions, performance. Fortunately, our performance has been decent. The fund has been around for 17 years, and we've managed to outperform the benchmark and the peers. I mean, we just use this for comp. In truth, we actually don't care about the benchmark. We care about real returns. But just FYI. Conclusion. Why do we care about real returns and not care about the benchmark? Because Sean and I, who run the fund, we invest our savings in the fund. Do we care about the benchmark? No. What do we care about with our own savings? We care about real returns, generating real return on our savings, so we can grow our savings over time and etc. And that's our goal. We invest along with our clients. We have a fixed fee structure. In actual fact, our fee falls, and very pleasingly, and thanks for all the support from all of you out there, our assets under management have increased. What does that mean? It means our fee falls. So for any assets over $1 billion of our fund, which it is now, our fee is only 0.6% fixed. We have no performance fee. We think performance fees are a joke and terrible for, it's a crazy concept. So we're not into that. So we just try to generate returns, trying to keep it simple, going where capital is not, and buying, we think, good businesses with net cash from the balance sheet. Why? Because low risk. And when we talk about risk, we talk about absolute risk, the risk of losing money. We do not talk about relative risk, guys. For us, it's an odd concept. So that's it from me. We a simple business, one fund, only all our assets are in the single fund, no segregated accounts. So all we care about is our single global equity fund and trying to generate returns for our clients. And again, we really appreciate the support. And if anybody wants to ask further questions, wants to meet Sean and I, our doors are very open. We're happy to tap to clients and potential clients. Eugene, are there any questions?
Thank you for that. Nothing from the audience. I've got one question for you, but it's a question that I frequently get from intermediaries, because I mean, if you look at any set of return data, whether it's Morningstar or Money Made, or wherever you go look. I mean, your returns really stands out at the moment. And clients that weren't invested, I think they've got a bit of FOMO. But the question that I get very often is, but aren't we buying this fund at a high? What's your answer to that?
So thanks, Joe. Sorry, that was my alarm telling me it's 15 minutes. Well, the fund is at a high, but if you look at the underlying stocks, so something odd about us, we're not high conviction, buy and hold forever type of people. We have positions, small positions in the funds, lots of them, and as something achieves our fair value, we sell it. It's gone. So actually, all the stocks that contributed to our return over the last 5 years are gone. European banks gone. Chinese pharma stocks that have done nicely gone. And actually, what you're buying is you're buying a whole new set of stocks, which we think are now cheap. So if you kind of cast your eye down our top 10, and you cast your eye down the top 10 of a year ago, I think the only company still there is Petrobras. And actually, Petrobras has been a big detractor. It's at its lows. So you're buying Petrobras at its 5-year lows. So no, you're not buying the underlying stocks at their highs. You're actually buying the underlying stocks at their lows.
Makes a lot of sense, because you take profit, move on to the next thing that can actually make clients money in real terms. Yeah, fantastic. Andrew, thank you so much for your time. I really appreciate it. Go enjoy the rest of France. I'm very jealous. But love to be there in a French cafe having a croissant and a very nice coffee. But I'll have to speak to my boss about that. Andrew, thank you so much.
Thanks for the invite. Appreciate it.
Thanks a lot. Right, we're moving on to our last session, sticking with global equity and global quality, but not quality at any price. It's my pleasure to welcome from Nomura Asset Management, Richard Cruz on the line already. Richard, thank you so much for joining us. Almost afternoon this side, not quite yet. Unfortunately, we gave you the graveyard session, but I looked at some of your presentation slides and looks to be very, very interesting. So thank you so much for your time.
I hope I'm going to survive the graveyard here. Thanks for having us. This is our first session with BCI. And I'll give a little bit background about myself and Nomura in a second. But it's interesting to be on after the colleagues of Renmore, because in many ways we are quite the opposite. But there's also some interesting similarities between some of the things we are looking at. But for me, that's a fascinating thing. You can make money in a value fund, and you can make money in a quality fund. And of course, it helps if you get the timing right, but you can succeed in many ways and fail in many ways. But maybe if we come to the fund, we'll take the first slide, and I'll give you a little bit of background what I'm talking about here. So we are one of the proponents of quality. And I mean, you've seen some of the other presentations, and there's some quality managers around here. So I will focus less about the commonalities, as we all look at about high quality companies. We kind of tend to identify them similarly: high returns on capital, good long-term investment opportunities, good management. We tend to be unconstrained. But 2 or 3 things that we see quite differently. We are not quality at any price. We are quite valuation focused. We have a team of 15 investment professionals working on this fund. 10 of them are sector specialists, and we run very detailed valuation for all of our stocks in a standardized way, and we don't like to overpay. So things that similar to Renmore, things that kind of reach our fair value, we try to sort out. So we're not buy and hold. We're not just great quality companies wait. And the other thing is we have a focus of about 3 to 5 years time horizon. So we are a little bit less concerned about the next fat step being 25 to 50 up or down. We are more focused on what are the best quality companies over the next 5 years, and specifically companies that improve in quality, and not ones that are high quality for a historic reason, but are actually going worse. So that's where we focus a lot of our efforts, weeding out the things that still look like quality and were quality, but are actually getting worse. And if I give you a little bit of background about Nomura Asset Management, Nomura, one of the biggest Asian asset managers, we manage about $590 billion of assets as of the last spring, 14 offices globally. I'm sitting together with the global equity team that manages quality and income products in the London office. But we work with our colleagues as well. So there's quite a backing of a large group here, and we are quite committed to this, and the fund is available at attractive fees. We agree with Ranmore, kind of the fee component matters for investors, and fees will come down, and we've kind of proactively positioned on that front to make sure that that this is going well for investors. So page 2 is our long-term track record, and that is quite nice. So in red, the strategy, and in gray, the benchmark. We are also kind of not very benchmark oriented. We are benchmark aware. You see the long-term returns are quite nice, and especially kind of 17 to 1920, kind of very nice returns, but kind of quite a wobble recently. And I wanted to look into that a little bit. So I'm focused here a little bit on topical 3 to 5 years. What has happened in global markets? What has happened to style returns, sector returns? Why are returns as they are? And how do we look at that going forward? Which I think is important for people to realize that there's kind of, it's not only about stock picking short to midterm. The quality and style and the sectors and what happens to them is quite important as well. So we've looked back at the last 5 years quite intently, but if we move to the next slide, that gives us our long-term kind of view and positioning. So these are slides that show the return of the MSCI World Quality Index over the MSCI World Standard Index. So if lines go up, that means quality is doing better than the general market. If lines go down, means quality is doing worse. Quality being defined by MSCI as a mix of high return on equity, high equity ratio or low debt ratio, and low profit volatility. So that's quality in this definition, and we are largely okay with that definition. So you see over a very long time, kind of at some point in time, our data subscription ends. So we started this at 1982. Over a very long time, quality has done very well for investors and much better than the general market. Why is that? Because quality companies are better able to defend their returns. So if you just own them long enough, you're going to be fine. But there is always periods where kind of quality doesn't work. And if we look at this chart, we had a period in the 90s where raw materials were doing quite well, quality was doing quite poorly. Then the other period where quality was doing quite poorly was in the run-up to the global financial crisis, where the US financials and housing bubble unfolded. That has been a bad period for quality, and then was immediately followed by very strong quality outperformance. But if we move to the right chart, we see kind of since about 2020 in Europe, and since about 1.5 years in the US, quality has really stopped working and has underperformed the market. And we wanted to shed a little bit of light on why this is, which trends we think are cyclical, which trends are structural. So where's the potential to rotate to quality, and if you have made nice returns in growth strategies or value strategies, should you take some of that money and maybe rotate towards quality, back towards quality? So what we've done in the next few slides is kind of looking at how sectors have done. So if we go to slide 4, the next one. So here we see the North American market, which is dominated by the US. I just took North America because that comes easier pre-configured. And on the left side, you see the sectors ordered from highest quality to lowest quality based on return on equity. And that's a 5-year average return on equity. And if we just look top to bottom, you see IT is clearly the highest quality sector. A staggering return on equity of over 50%. Of course, this is influenced by a few big companies that have bought back many shares. There's two ways of looking at buybacks. Buybacks financed by debt, probably not great. Buybacks financed by very strong cash flow from a clean balance sheet, quite great. So Microsoft or Amazon, some of the companies we own, are more on that front. And you look at the bottom of the table, utilities, real estate, quite low return sectors. But on the right side, we see the return over 5 years, the annualized 5-year return. And kind of to nobody's surprise, in the US, IT, highest quality growth has really kind of shot out the lights, 34% annualized total return, but actually with quite a high dispersion. So for example, last year, 2024, 70% of growth stocks underperformed, and actually 70% of growth funds underperformed because they didn't own the right stocks. So it matters what you own. But then the next observation is the next two highest quality sectors, consumer staples and healthcare, haven't worked very nicely at all. So the returns are clearly below the average, despite their high quality. And we've seen much better returns in sectors that are kind of somewhat still quality industrials, but also quite some nice returns in financials and quite some nice returns in energy. We're going to come to kind of some of the structural drivers later. I want to first contrast this a little bit with the European market, which also makes clear a little bit kind of our view on the US and other things. So if we go to the next slide, we've done exactly the same thing. We've taken all sectors ordered by quality, put the returns on the right side. So first observation is Europe, actually IT is not the highest quality sector. It's quite close, 27 versus 27.2, but healthcare is the highest quality sector. But you see in general, most returns are in Europe are below US. So US market, despite all the complaints, is still producing much nicer returns for shareholders, which of course is also reflected in higher valuation. And we as a quality house think deservedly so. But what you really see in Europe is, and I mean that links back to that first chart of the short-term quality underperformance. Quality hasn't worked at all in Europe. Very poor performance in healthcare and consumer staples. European IT shares didn't do very well. So if you've had a growth fund, it was overweight Europe, that probably didn't work. What worked in Europe, industrials, similar to US, worked okay. But what really worked in Europe, and the Ranmore colleagues have talked about that as well, is financials have really shot out the lights. Why? Because we came from very poor starting points, very great picking grounds for value investors. It's something that we don't touch because we stay close to our expertise and our style. We did see that financials were very cheap, but we're not going there. I think people are better served by other funds doing that. We stick to our quality mantle, and we do think it will work longer term. So let's have a look at slide 6 and explore a little bit what we think, why the last 5 years were as they are, and what is cyclical and what is structural. And structural we need to be wary of because we don't want to fall into quality traps. So we had a very interesting cyclical background. And if we really look back, kind of 2020, we had COVID. So what happened? Energy prices tumbled. So really cheap, really poor returning energy stocks. And we had a collapse in interest rates, and financials really collapsed because people felt the economies couldn't cope with COVID. Lots of companies would go bust. Everything would crumble. Everything goes into online. So we had a huge high-flying sector of software stocks that after that did very badly. What happened then is we got Ukraine conflict, we got military escalation, we got a spike in energy and resource pricing, we got high inflation, we got interest rates all of a sudden going from incredibly low to kind of towards 10-year highs. And that has really boosted many cyclical areas. So basically, we've been pitching in cyclical areas, in low quality areas. You got around the best prices in 2021, 2020, and you're now really seeing 5 years of good returns. But these areas mostly don't look cheap anymore. On the flip side, 2020, what did everybody talk about? Where do I go? Do I get my food? Where do I get my toilet paper? So consumer staples were really expensive, highly valued safe havens, because people thought that's the one thing that survives even in a crisis. And healthcare stocks were boosted by a lot of investment into life science, fighting COVID virus, vaccinations, treatments. So healthcare stocks were expensive and from there have normalized. But we do think these factors are cyclical and they've largely run their course. Then what is more structural? We do think the strong performance of IT and wider technology area is largely here to stay. While there's plenty IT companies that we find are overvalued, there's also plenty of IT companies that still produce stellar values for shareholders. If we look at Microsoft, 65% up over the last 2 years. Nothing much to complain here about. And with a squeaky clean balance sheet and very high RE, we still think that that's still very attractive segment of the market. But you need to pick the right IT companies. There's plenty that is overvalued, and there's plenty IT companies today that are still lower than they traded 2021 because they were trading at stupid valuations. What we also see as structural is there is a clear impediment in our view in consumer stocks. Consumer segments were kind of really loved by many quality managers. We haven't loved it for quite a while. We feel consumer markets are really changing. You have a fragmentation of demand. People want to do healthier. People want to do gluten-free. People want to do high protein. People want to do low carb. People want to do this, want to do that. So if you look at things like Coca-Cola that really kind of appeal to kind of 60-70% of the population, that is all going down. So markets are fragmenting. There's lots of startups serving smaller niches enabled by social media. I'm sure you're getting bombarded by social media as well for your special interests. Lots of new brands popping up. The big guys not knowing, do I need to buy these brands? Do I need to launch it myself? Do I fragment my my assortment that brings down return? So we are still quite negative on this consumer segment, despite quite some negative performance in the last few years. So if we hop to the negative slide, next slide, we're going to show this a little bit in terms of valuation, and we've picked out the US because the trends here are most marked. And you see IT shares aren't cheap, but they are still a good way away from the bubble territory they had at certain levels. And we feel the returns are actually quite high. And the competitive intensity, while everybody's throwing money at it, like the large corporates only buy from large corporates. So in many areas, we're talking oligopolies here, very much contrary to the consumer side. The other sectors we put in here, if you look at consumer staples, kind of the pinkish line, they're still not cheap. Despite very poor performance, people still cling on to these stocks. We don't find them very attractive at all. We are basically zero weight consumer staples in our fund. We sold the last staples stock more than 6 months ago. Healthcare, we find very cheap. We think the sector was a little bit expensive at some point in time in 2021, but basically now it's screening very, very cheap in contrast to many other areas. It's only held down by lots of Trump talk about intervention in healthcare system. But if you've seen how Trump has played out in many areas, he makes big announcements, then he now announces tiny victories and the stocks go up again. So that has happened on tariffs. We are quite certain the same will happen in healthcare. Once clear announcements here, the market has a more certain area to price. Trump will declare victory, but it will really not impact the healthcare system. And we still think the healthcare area is very promising. And financials here as a graph, you see that kind of over since 2018 by now, financials aren't cheap anymore. So we think that that part of the value rally has largely run its course. And we are much more positive that in the next 3 to 5 years, quality will do quite well again. So that also probably wraps up what we had put on slide 8. And given that we are all running over, I'm going to hold that a little bit short on slide 8. So we are still positive on IT, but very selectively so. Only the high quality companies and only ones that are on valuations that we can clearly explain with conservative inputs. Still modestly positive from industrials. Industrials put in place many of the infrastructure we need for IT, electrification, changes in the global energy production. So they're still quite positive. Healthcare, we are quite positive because valuations are low. We don't see that the market has changed or will change much. And once the Trump noise abates, we see significant recovery potential for these stocks. And consumer staples, the one area in quality that we don't like at all, valuation isn't nice. The trend is negative structurally. We stay largely disengaged, and we look for kind of similar areas of consumer exposure in other sectors. So one of our larger exposures is a stock like Compass Group, which does food services, canteens, outsourcing for big companies, healthcare companies, where they really have an oligopolistic position. They don't have to compete with 20 startup brands, and we try to do this in a smarter way. So that's kind of our quick tour de force, what has happened in the last 5 years. And maybe that has been interesting to you. Maybe it has triggered the odd question. Happy for that, or any other things you throw at me.
Richard, thank you very much for that. And I mean, you did explain your process extremely well. A lot of quality managers out there, but you look at sectors, typical quality managers wouldn't necessarily venture in and not buying quality at any price. And they made that comment as well, and I had a bit of a giggle. So some of the quality companies are trading at stupid valuations. Maybe just one question, just to understand your investment process a little bit better, and maybe let's use one as an example. NVIDIA might be a good example. It's some managers are totally in love with NVIDIA and reckons how high can a tree go? I mean, maybe that's the answer. Your thoughts on NVIDIA in a quality portfolio?
Yes, clearly the AI angle has worked. I mean, we've been thoughtful about this. Kind of 2 years ago, NVIDIA looked too high valued for us, and it looked too uncertain to kind of give us enough comfort to buy this for 5 years, 10 years out. Clearly, the ones who have been positive on it have been right. And of course, we all wished we had it, and maybe some of you had it, and congratulations. I hope you're closer to retirement. That's all good, but it didn't quite fit for us, but we've actually profited in IT quite a lot from AI and related. So things like TSMC, the biggest chip producer, that basically all NVIDIA chips are produced by TSMC, that has produced very nice returns, not quite as good as NVIDIA, but also very well and much lower valuations. A peer of NVIDIA, Broadcom, that makes specialized AI chips, we own as well. And actually, we've recently decided that NVIDIA is actually too big and of an underweight to ignore. So we've recently bought the stock and put it at equal weight. That more had to do that we kind of deprioritized some other AI stocks. So we are sitting somewhere in the middle. We are not all out bulls, but we do see that the visibility for AI has improved a lot. So we are much more comfortable making a 5-year forecast. But on current valuations, it's not a strong buy for us. We still prefer shares like TSMC, Microsoft, or Google that have the better combination of valuation and quality for us. But it's a stock that we've observed for quite a while, and we've put into the portfolio, but currently only around neutral weights. And we will consider doing more, but only on cheaper prices. Yeah.
Richard, thank you very much for that, and very good initial presentation. I mean, there's a lot of questions coming in from the audience as well. We can maybe try to circulate some of those questions to you, and you can respond to that.
Very happily, yes.
We're very much looking forward to seeing a lot more of Nomura Asset Management as time progresses. So this was a good introduction to your business definitely a long time track record as well, and it does offer a different approach to quality than what we are typically used to. So thank you so much for your time on coming on the session today. We really appreciate it.
Many thanks for your time, and yeah, hope to catch you next time, and come with hopefully more encouraging thoughts, and maybe that next time we'll bring some stock examples that better highlight our process.
Fantastic. Thank you so much. To our audience that joined us today, thank you for your continued contribution. I know we're a little bit over time, so thank you for your patience as well. I think it's been very insightful. Next week, Wednesday, we'll continue with some of the top global asset managers and bring you some more thoughts on what to look for or maybe what not to look for